Spring Cinemas, 2 standard tickets only, cheapest free. T's and C's apply.
Do you remember picking out your engagement ring in the jeweller's window? Or choosing your first home? Or deciding the names of your children? When it comes to the important choices in life, you've always taken the greatest care. So shouldn't the same go for which firm of funeral directors you use? After all, that's an important choice too. At Dignity Funeral Directors, we're like you. We also take the greatest care. Our name as your assurance will be there by your side every step of the way. Just look for the sign that says Dignity. It's on all our branches and on the Dignity website. Dignity Funeral Directors, taking the greatest care.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119 and around the globe. The Bloomberg Business app and BloombergRadio.com. This is Bloomberg Surveillance.
From New York City, this is Bloomberg Surveillance for our audience worldwide. We're live on Bloomberg Radio, 2 hours away from the opening bell. The news you need to know this hour. U.S. equity futures struggling for direction as earnings and economic data present a mixed picture for the global economy. In Germany, a rebound in factory orders. They rose 1.3% in September, topping estimates for a gain of just 0.1%. On the corporate front, we have word of a possible acquisition. The Wall Street Journal saying Xerox is considering a takeover offer for HP. That has shares of HP up 9% in pre-market trading. And finally, when it comes to earnings, SoftBank's reporting its first quarterly operating loss in 14 years. Write-downs from investments like WeWork and Uber saw the Japanese company lose $6.5 billion. A little bit more on that a little bit later. Let's get you the headlines from elsewhere, shall we? Let's say good morning to Michael Barr. Good morning, Michael.
Thank you very much, Jonathan. Thank you, Paul. Thank you, Lisa. In a race that is deemed too close to call, late last night, Democratic candidate Andy Beshear declared victory in Kentucky's governor race over current Republican Governor Matt Bevins. But Bevins refuses to concede the race just yet.
We want the process to be followed. The process will be followed. And in the end, we will have the governor that was chosen by the people of Kentucky.
Beshear leads by about 4,000 votes. In Virginia, Democrats are celebrating their dominance of both houses of the state legislature for the first time in more than 20 years. We're learning more about New York City Police Commissioner James O'Neill's new job. O'Neill will be going to work for Visa on December 2nd. The company said in a statement today that O'Neill will be a senior vice president and global head of physical security. O'Neill announced Monday that he will be retiring from the New York Police Department. Chief of Detectives Dermot Shea will succeed him. Global news, 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts, more than 120 countries. I'm Michael Barr. This is Bloomberg, Jonathan.
Michael Barr, thank you, sir. It's time now for the Bloomberg NBC Sports Report. Here is John Stashower.
John, opening night in college basketball, marquee doubleheader at the Garden. The teams that begin the season ranked 3rd and 4th in the country squared off, followed by the teams ranked 1st and 2nd. Duke topped Kansas 68-66, and then Kentucky beat Michigan State 69-62. High hopes this season at Seton Hall because Miles Powell decided to stay in school rather than turn pro. He scored 27. The Pirates opened up with an easy win over Wagner. 2 city schools met at Rose Hill. Fordham beat St. Francis. We heard for the first time from the College Football Playoff Committee. Their first rankings have Ohio State first, and then LSU, Alabama, and Penn State. LSU plays Alabama on Saturday. The Islanders stay red hot. Their 10th win in a row. They beat Ottawa 4-1 in their first game this season, played in Brooklyn. Even in the early 1980s, when the Islanders won 4 straight Stanley Cups, only once did they do what this team has done, 10 straight wins. Devils a 2-1 shootout win at Winnipeg. Week 10 NFL begins tomorrow night. LA Chargers in Oakland. There was a report the Chargers are considering moving to London. The NFL and the team owner both saying it's not true. With the Bloomberg NBC Sports Update, I'm John Stashower.
John Stashower, thank you, sir. You've had the sports, you've had the news. Let's get you some price action, shall we? This Wednesday, equity futures going absolutely nowhere on the S&P 500. With firmer, we pick up by not even 0.1%, up by around about 2 points on the S&P 500. In the FX market, the euro firmer, the data out of the eurozone improving. Factory orders out of Germany doing okay, better than expected. Likewise for some of the PMIs on the continent as well. That has the euro stronger by about 0.1%. And in the bond market, after yesterday's sell-off, Treasury yields higher. Today, Treasury yields just a little bit lower, down a basis point to 1.84 on a 10-year. On a 2-year note, 1.6%. from the Bloomberg Interactive Brokers studios here in New York City for our audience worldwide. You are listening to Bloomberg Surveillance alongside Lisa Abramowitz and Paul Sweeney. I'm Jonathan Ferro. Tom Keene will be coming to you at the top of the hour, 8 a.m. Eastern, with the Chicago Fed President Charles Evans right here on Bloomberg Radio. You do not want to miss that conversation. For now, let's turn to the Bloomberg NJIT STEM report. It's brought to you by New Jersey Institute of Technology, offering hands-on learning in the largest maker space in New Jersey for those working in manufacturing and mechatronics. More at njit.edu/manufacturing. With the NJIT STEM report, here's Bob Moon.
Jonathan, good morning. Here's what's making news in science, technology, engineering, and math. It's happened again, and Facebook says it didn't know what it was doing. Don't bother stopping me if this sounds familiar. For the past 18 months, Facebook says it unknowingly gave outside developers access to private user information. It's seen no evidence of abuse, but it's reaching out to 100 third-party developers who had access to that data, asking them to delete anything they may have saved. How many users were affected? To that question, Facebook says, in effect, none of your business. Bloomberg has been conducting the biggest survey of Tesla drivers ever, and the latest installment is a fascinating read. It's focused on the system that Elon Musk says will lead the world to a new era of driverless transportation, the feature Tesla calls autopilot. We asked 5,000 Model 3 owners about Tesla's software for automated driving on highways and in parking lots, and more than 90% said the feature makes them safer. At the same time, those owners reported more than 1,600 close calls involving the software, including phantom braking, veering, or failing to stop for a road hazard. Bloomberg's Craig Trudell points out that shouldn't really be all that much of a surprise.
This sort of messiness of the findings of this survey reflects the messiness of the future of automated driving, in that there are going to be times that these systems save us, and there are going to be times that as these companies are ironing the kinks out, that they put us into dangerous situations.
Still, some results are nonetheless striking. While some say autopilot actually contributed to a collision, a few went as far as crediting the system with saving their lives. That's the Bloomberg NJIT STEM report. Jonathan.
Bob Moon. Thank you, sir. Bob Moon there with the Bloomberg NJIT STEM report. It's time now for 5 things, an original version of it. We will get to 5 things you need to know to start your day. Brought to you by Portfolio Analysts, powered by Interactive Brokers. Savvy investors use Portfolio Analysts to create a consolidated view of their finances and check the health of their complete financial portfolio. Download for free at ibkr.com/p. Guys, let's start with the better data. Lisa Abramowitz, it improves in Europe.
Yeah, and this sort of builds on what we've been seeing with PMIs, certainly out of Eastern Europe, too. This idea that there's been a stabilization and even an uptick when it comes to German orders. This is sort of raising some serious questions, right? Is this the beginning of something more sustained? Is this just a blip based on terrible comparative data? I don't know.
Ton of Fed speak through the day as well. Chicago Fed President Charles Evans coming up with Tom Keene in just a moment. Paul, the Fed looking quite united compared to the division of most of this year.
It does, and I think, if you're on the Fed, you can certainly take a victory lap today, and in terms of negotiating, what seems to be a soft landing for the U.S. economy. Right now, the expectations are for just one more cut sometime, maybe mid-2020.
A soft landing on a very, very narrow runway for the Federal Reserve. If they nailed this, well done, because it's increasingly got increasingly difficult through much of 2019. Can we just have a word, Lisa, on a banking union in Europe? The German finance minister talking about the prospect of common deposit insurance. This is actually quite important, but then you read the detail and it's not as encouraging.
I just don't see it. They've been talking about this for a long time. Can you imagine Germany giving up the sovereignty of its Bundesbank system? Can you imagine any of these banking systems in the different countries giving up their sovereignty and, frankly, the oversight? Because if you have insurance in a centralized location, then you better have oversight in a centralized location and the enforcement mechanisms for that. And all of a sudden, you're talking about a lot more than just insurance.
This has been really, really important to get through in Europe, to have the banking system further integrated, to have common deposit insurance, to cut that link between the state and the banking sector. The German finance minister just folding just a little bit, but then you read the detail and he still wants the domestic governments of, say, Italy, France, Spain, to exhaust their domestic funds first before they go to a common insurance European-wide effort.
Which goes to the heart of frankly, a conundrum in Europe, which is that Germany has pledged to be austere, right? And they're not moving away from the balanced budget plan, which is creating a lot of issues for people who want them to do more fiscal stimulus. And they want to impose that on some of the peripheral nations that are being more fiscally, I guess, I don't know, what's the word opposite of frugal?
Yeah,
what?
Just liberal.
Liberal. Thank you.
Yeah,
Thank you.
But we need consolidation in European banking. That's clear. I'm not sure if this is a first step or not.
Number 4, SoftBank. Number of the morning, isn't it, Paul Sweeling? Negative $6.5 billion.
Even for Masayoshi-san, that's a big number. It's the first loss in 14 years, and it really calls into question his vision for technology and for valuation. But he is defiant. He says we're going to raise another $100 billion Vision 2 fund. We know what we're doing. We're going to continue to invest in technology globally in a big way. So I'm just a question of where is he going to raise this next fund, given some of the big misses we've seen here in terms of WeWork and Uber.
Lisa just sitting here shaking her head.
Well, I personally think that there is one point that we just have to keep hammering home, that nearly 2/3 of the money in the $100 billion SoftBank fund is borrowed money from 2 Middle Eastern investors, and they have to pay a 7% coupon on that borrowed money, which amounts to $2 to $3 billion of interest payments per year.
Yeah.
Anyway.
I've said we need a Lisa cam. Every time she gets annoyed, the faces.
Oh, of course.
They're worth $6.5 billion. SoftBank can break even. Guys, number 5, just quickly, Ray Dalio. The world has gone mad, Lisa.
Yeah, well, and he's talking about how you can get credit if you have money. If you don't have money, you can't.
That's often a problem. 5 things you need to know from New York City for our audience worldwide. This is Bloomberg Surveillance.
Have you wanted to speak a new language, but you thought it'd be too hard or take too much time? Then go to Babbel.com, download the app, and try it for free. In just 15 minutes a day, you'll be on your way to speaking a new language in just a few weeks. And right now, you can try Babbel for free. Babbel starts out teaching you words and phrases by matching them with pictures. You won't believe how easy the interactive program is. Soon the sentences get a little bigger, and before you know it, you're having simulated conversations voiced by native speakers. And because Babbel is crafted by language experts and uses the spaced repetition method, in just 10 to 15 minutes a day, you'll be speaking the language of your choice with real confidence. With Babbel, you can speak a language. Just go to Babbel.com and start your first lesson in the language of your choice for free. Download the Babbel app or go to Babbel.com and try it for free. That's Babbel.com.
Why has J.D. Power ranked Commonwealth Financial Network number 1 in independent advisor satisfaction among financial investment firms for the 6th straight time? We think it comes down to one thing: you. Because it's your input and feedback that keeps us focused on what's most important to you and your clients, and continually pushes us to be the best we can be. Maybe that's why we receive top marks in every category of the J.D. Power 2019 Advisor Satisfaction Survey. They named us number 1 in client support, number 1 in firm leadership, number 1 in operational support, number 1 in compensation, number 1 in professional development support, and number 1 in technology support. Ready to partner with the best? Call Commonwealth at 866-462-3638 or visit commonwealth.com and feel the power. Member FINRA, a registered investment advisor. For 2019 J.D. Power award information, visit jdpower.com/awards.
With a Bloomberg...
At Argos, get them the toys they're dreaming of this Christmas. Save 20% when you spend £20 or more on toys with code TOYS20, including top brands like Peppa Pig and Lego. Enjoy same-day home delivery 7 days a week. With Argos, you're good to go. Offer ends the 12th of November, subject to availability. Exclusions apply. Delivery conditions apply. Order by 6 p.m. 90% UK coverage.
This winter, why not take the short flight from London to Dublin with Aer Lingus from just $32.99 each way as part of a return trip. From coastal walks to cosy pubs and friendly locals, you'll find so much to enjoy once you're there. Smart takes a Dublin city break. Smart flies Aer Lingus. Book now at airlingus.com. Terms and conditions apply.
Oh, a decent drill would make DIY so much easier.
Whether you're laying flooring or fitting shelves, head to the B&Q Tool Shop. Get hands-on in store with our wide range of drills, including the Bosch Universal Impact Combi Drill for just £80. The B&Q Tool Shop. You can do it when you B&Q it.
Do you remember picking out your engagement ring in the jeweller's window? Or choosing your first home? Or deciding the names of your children? When it comes to the important choices in life, you've always taken the greatest care. So shouldn't the same go for which firm of funeral directors you use? After all, that's an important choice too. At Dignity Funeral Directors, we're like you. We also take the greatest care. Our name as your assurance will be there by your side every step of the way. Just look for the sign that says Dignity. It's on all our branches and on the Dignity website. Dignity Funeral Directors, taking the greatest care.
College football is live on TuneIn. Listen for free to games from more than 140 schools all season long.
To the 10, all the way to the checkerboard.
This Saturday at 3:30 p.m. Eastern, number 1 LSU is taking on number 2 Alabama with a battle between LSU's quarterback Joe Burrow and Alabama's QB Tua Tagovailoa. Both are potential number 1 picks in the NFL Draft. Listen to every call and every game of your school all season long for free on TuneIn. Just search college to listen today.
You're listening to TuneIn, where you can hear all the audio you love in one place. Live NFL games, the hottest music, breaking news, and podcasts. Push play and go about your day, only on TuneIn.
Global news 24 hours a day, on air and at TikTok on Twitter. Powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg Radio. Now, a global news update.
Thank you, Kentucky!
Kentucky's Democratic Attorney General Andy Beshear is being called governor-elect by some after edging out a razor-thin margin over incumbent Republican Matt Bevins, but Bevins has not conceded and is charging voting irregularities. Mississippi voters have chosen Republican Tate Reeves to be the new governor, while Virginians have given control of both houses of the state legislature to Democrats for the first time in a generation. An arrest has been made in connection with the massacre of 9 Americans living in the northern Mexico state of Sonora. Nadia Romero is following developments.
The Attorney General for the neighboring state of Chihuahua didn't disclose what the suspect's involvement might have been, but says a newly formed drug cartel could be behind the massacre.
Britain's 5-week election campaign officially got underway today when Parliament was dissolved ahead of the December 12 vote. Stock futures are nudging just barely into green this hour, ahead of Wall Street's opening bell, with global markets higher. I'm Michael Toscano.
Why all the top-tier experts? Because business is not a magic trick.
Give us a sense of the economic backdrop.
Bloomberg Markets.
Which financial records are these?
Weekday mornings at 10 Eastern on Bloomberg Radio. Bloomberg, the world is listening. Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at TikTok on Twitter. This is a Bloomberg Business Flash.
And I'm Karen Moscow. U.S. stock index futures struggling for traction this morning alongside stocks in Europe as a raft of corporate earnings and economic data presented a somewhat muddy outlook for the global economy. Treasuries are rising after dropping for 3 days. We check the markets every 15 minutes throughout the trading day on Bloomberg. S&P futures are now up about 3 points. Dow futures up 29. NASDAQ futures up 7. The DAX in Germany is up 0.1%. 10-year Treasury up 5/30 seconds, yield 1.84%, and a yield on the 2-year 1.60%. NYMEX crude oil down 0.5% or 28 cents at $56.95 a barrel. COMEX gold up 0.2% or $2.80 at $14.8650 an ounce. The euro 1.1088 against the dollar. British pound 1.2881 and the yen 109.01. Shares of HP up more than 8% in early trading after the Wall Street Journal reported Xerox is considering a cash and stock offer for the PC maker. CVS Health also rising up 2 1/3%. It raised its forecast for the year after reporting strong results across the pharmacy services, health insurance, and drugstore segments in the third quarter. And Barrick Gold increased its quarterly dividend by 25% as the world's number 2 producer reported earnings that beat analyst estimates. And that's a Bloomberg Business Flash. John, Lisa, and Paul.
Hey, Karen, thank you very much. I'm Jonathan Ferro alongside Lisa Abramowitz and Paul Sweeney. Tom Keane coming up at the top of the hour, 8 a.m. Eastern Time, here in New York for our audience worldwide, catching up with Chicago Fed President Charles Evans at the Council on Foreign Relations. We'll bring that conversation in full and live right here on Bloomberg Radio. Pleased to say that phoning in and joining us now, Jeff Yu, UBS Wealth Management Head of the UK Investment Office, joining us out of London. Good morning to you, Jeff.
Morning.
We remain underweight equities. That's the line from you guys still. Why, Jeff?
Well, right now, we just think there needs to be a distinction between pricing out the downside, pricing in the upside. I think these two are separate things, and we may have started to confuse the two a bit at this point, and I think it's important to make that distinction. Look at where earnings growth is heading, just look at where economic growth is heading. I think it's a bit too early to pop the champagne bottle corks for now.
So, Jeff, we got some European economic data today, a little bit better on the margin. What do you take of that?
Well, I think it's important to look at what's better. So on the services side, it's all looking a bit better. But can we say the same for manufacturing and taking a step back? What actually is driving Europe? What are the drivers of Europe? If you look at German factory orders out today, down 5.4% year on year. Sure, the monthly number was better, but I still think there are quite a few challenges up ahead, and that will only strengthen the conversation whether fiscal is going to happen.
Jeff, how much pushback do you get from your clients?
Not as much as one would think. I think I think for the last 2 or 3 years, with the exception of maybe December last year, it has been a case of owning this rally reluctantly. I think the whole market's reluctant bulls right now. U.S. equities being a big overweight, for example, because there's simply a lack of alternative, and I don't think that's changed too much. However, I would say that this talk of late cycle probably has, compared to even a year or two ago, has really come off. So we're just taking a day at a time. I don't think there's too much pushback. There is a bit of an opportunity cost of not being more aggressively in the market, and it's something that we'll be cognizant of.
Jeff, let's talk about the trade negotiations. The so-called negotiation gaps have closed. I just wonder what's left. Is that a cause for concern or hope?
It's not a cause of concern per se, because I just still think there's a disconnect between what the market's expecting and what realistically the two sides can actually put forward. For the best part of the summer, China's been stressing it's important to separate the structural issues and the second track of IP, of tech, things like that. From the tariff side of things, the tariff side was always going to be the easier one. Political window dressing versus the long-term structural issues, which will be a multi-year, even a multi-decade process. So I don't think those gaps are that wide at all. But our market's looking for more at this point, and on balance, I would say yes. So I think that's where there is scope for some disappointment, but we have to bear in mind shorter-term relief. That's always welcome, and it's something that we can look forward to.
A lot of people have been talking about how the trade tensions have already impeded certain businesses. Are there certain businesses that you stopped investing in because of the effect of the ongoing trade skirmishes?
I really think you're seeing this across the board, and that's why it's important to keep relatively conservative in a growth forecast for next year. On the one hand, for companies directly involved in trade on the front lines, whose products will be hurt by tariffs, clearly they need to hold back on investment. But then that will filter down through the supply chain, right? So if there's a general slowdown in growth, take Eurozone for example, that's being impacted. Then further down the supply chain, it will impact services, it will impact manufacturing as well. So the inputs into the companies being invested. So I think that's holding back investment in general right now. It's holding back capex, and it's something that, again, governments may have to step in terms of fiscal.
There's just a view that things have got better, that the probability of escalation risk between the United States and China has diminished, and Brexit risks have receded as well, Jeff. The Prime Minister is speaking outside number 10 Downing Street at the moment. The campaigning has already started. The government, he says, has an oven-ready Brexit deal. What's the guidebook for the next 5 weeks in the UK and the issues around Brexit for markets?
Well, I think rule number one is don't believe a thing that the polls are saying, right? We've all been there before on both sides of the Atlantic, so I think that's important to take into account. And also, manifesto promises, that whether that can be realised is a separate issue. But I do think we can see some convergence in terms of everyone's going to be pledging to actually spend a bit more. So that may make life a bit easier, for those worried a bit about growth. But I would say follow things as they go along, and just bear in mind sign this deal right now, that's it's a withdrawal agreement. We're still some ways to go, before establishing the long-term relationship between the European Union and the UK. And of course, when we get to the 12th, the evening may throw out some surprises, and we'll just go from there.
So, Jeff, it's interesting. I think it's one could argue, as you just mentioned, don't believe the polls, and it's all going to come down to the election. That sounds to me like I'm just sitting on the sidelines here. I mean, it's way too close to call here. Lots of different things could actually occur here. Is that kind of what you're hearing from some of your clients?
Totally. And if you look at how we're positioning for this, take FX, for example, the move in sterling we've seen is the pricing out of no-deal risk, right? So similar with trade, you want to price out the risk of a total breakdown or further escalation. But to go beyond, say, 132 and cable, to make a dash through 135 or to 140, that's going to be a more medium-term issue. We have to establish, what happens after the election, and B, what that long-term relationship is going to be as well. So for now, it's a holding pattern. You've taken off your underweight, you've removed some of your shorts, but that's again different from going long.
So if there is some sort of Brexit agreement in the near term, are you going to flood into London real estate?
There have been plenty of questions on that, from our international clients. That's a traditional source of investment, waiting for John to send in his bids as well. But at the same time, I do think, that will depend, on the overall, regulatory framework, the tax framework, along with, what the government policies, are as well. Because if you look at the market here, it really goes well beyond Brexit. Clearly, the uncertainty has not helped, but there are many moving parts to that side of things. But inquiries certainly picking up this year compared to the last 2 years.
Just for the record, I'm not sure I meet the minimum requirements to open a UBS account.
but John,
I don't think I do anyway.
Do you think that you'd buy London real estate, John, or do you think it would be countryside?
Are you trying to get me in trouble?
Totally.
On this show?
100%.
Look, I think there's going to be a lot of appetite for London real estate, given that it's been held back so much, Jeff. But you've got to get over several obstacles. One is not just the divorce agreement. The next is the agreement beyond that. What does the future relationship look like? And I just wanted, Jeff, to that degree, the wall of capital that some people think exists, that is waiting to go into the UK, does it wait for the election to end, or does it wait for the next stage of discussions with the European Union to close?
I don't think it will need to wait for the next European discussion, because if you look at some of the international, interest, very little of that over the last, decade or two, has been for the UK's relationship, for the EU. I think, that's just an asset allocation, diversification. They see this as an attractive market. So I think that side of things, unless you're an entrepreneur that wants to invest in a business, and let's say, there's a commercial element to it, perhaps the EU negotiations will matter. But for private individuals, I think that's secondary. Yeah.
Just before we let you go, Jeff, let's get a conviction call from you. What's the big call from you guys at the moment?
So still, I would say we will push back against the notion of adding aggressively to risk. We prefer to be somewhat underweight, clip the coupon, clip the dividend, and then just focus on the growth outlook and see where the next catalyst comes from. But staying underweight for now.
Hey, Jeff, always great to catch up with you. If you change the call, no doubt, give us a call and we'll catch up. Jeff Yu, UBS Wealth Management Head of the UK Investment Office, joining us out of London on trade talks, Brexit, and where to put your money or where not to put it. Equity futures ahead of all of this, up 0.1% on the S&P 500. All of this being a conversation at the top of the hour between Tom Keene and the Chicago Fed President Charles Evans. Are they all singing from the same hymn sheet at the moment, Paul? I get the impression they are.
It seems like it's a little bit more cohesive than it was maybe earlier this year. And I think that if you look at the data, which is the Fed says they are data dependent, there's a lot in the data to say what the path that they are on is actually working, and it's within reason, and it's certainly enough for them to pause, at least maybe going into 2020.
It's cohesive because they're all just basically shrugging. I mean, basically they don't feel any urgency one way or another, so they can just all sit back and keep watching things roll in.
Rich Clowder telling Bloomberg about a week ago on Friday, monetary policy in a good place, the economy in a good place, and it sounds like a lot of people on the FOMC at the moment agree with him. Charles Evans coming up next, the Chicago Fed President sitting down with Tom Keene here in New York City. That conversation coming up on Bloomberg Radio. From New York, this is Bloomberg Surveillance.
It's another Wednesday afternoon, yet another cold day. So ditch the British winter and chase the sun across the globe with British Airways from London Gatwick and explore tropical rainforests. Fly from London Gatwick to Costa Rica with British Airways. From £218 each way based on a return fare. Don't miss out. Book by November the 12th at ba.com/wintersun with British Airways. Incredible is within reach. Booking fees and conditions may apply. Limited availability. Selected flights in March.
Do you remember picking out your engagement ring in the jeweller's window? Or choosing your first home? Or deciding the names of your children? When it comes to the important choices in life, you've always taken the greatest care. So shouldn't the same go for which firm of funeral directors you use? After all, that's an important choice too. At Dignity Funeral Directors, we're like you. We also take the greatest care. Our name is your assurance we'll be there by your side every step of the way. Just look for the sign that says Dignity. It's on all our branches and on the Dignity website. Dignity Funeral Directors. Taking the greatest care.
Watford. On chilly days like today, forgetting to turn the heating off is easily done, especially when you're out enjoying some lunch. But it's nice to know with Hive Active Heating, a Which Best Buy, you can turn your heating off from wherever you are. And by never having to heat an empty home, you could save up to £120 a year on your heating bill, which sounds like the perfect excuse to order another course. Search Hive Heating to buy now. Hive services require broadband and Wi-Fi. Terms apply.
The world, 24 hours a day at Bloomberg.com, on the Bloomberg Business app, and at TikTok on Twitter. This is Bloomberg Radio. This is Bloomberg Surveillance Economics.
The good news is the economy is strong. The bad news is the economy is strong.
Financial crises take a really long time to recover from.
Finance.
The strong job market's pulling people back in.
You can't have for very long, monetary union without a fiscal union.
Investment.
What we preach is extreme diversification. It's hard to have sustained productivity without capital investment.
Bloomberg Surveillance with Tom Keene and Jonathan Farrow on Bloomberg Radio.
From New York City for our audience worldwide, good morning. This is Bloomberg Surveillance. Coming up on the program, shaking off a global growth scare, the latest economic data slowly improving as the Federal Reserve Division fades. Chicago Fed President Charles Evans speaking to Bloomberg this hour, and SoftBank reporting a $6.5 billion loss from investments in money-losing firms WeWork and Uber. From the Bloomberg Interactive Brokers Studio, hello Wednesday. Here is your Wednesday morning price action with equity futures positive a 0.1% on the S&P 500. We are up by around about 3 points. Yesterday, Treasuries lower, yields higher. In today's session, Treasuries advance, yields creep just a little bit lower, down 2 basis points to 1.837% on a 10-year. On a 2-year note, we come in 3 basis points, just south of 160. Your yield on a 2-year, 1.596%. Bloomberg Surveillance today is brought to you by Cohn Resnick. Transform your tax game. The Cohn Resnick team can help deal makers develop a winning tax strategy. Visit CohnResnick.com/tax insight. I can tell you here in New York, I'm pleased to say the Chicago Fed President Charles Evans has just taken a seat. Our very own Tom Keene is sitting down with him at the Council on Foreign Relations. And guys, that conversation is about to begin any moment. Paul, we talked about this just briefly. Just a little bit more unity at this Federal Reserve than maybe there was a couple of months ago.
Yeah, I think that's right. I think we're starting to see that a little bit. And again, they can probably take a look at each other and say, we're doing a decent job on negotiating a soft landing for this economy. The data that the Fed looks at can probably point to, a decently performing economy, certainly relative to other parts of the world.
Everyone feels good today. I love what Tom Purcell said. He said, everything suddenly is working out just great and nothing has changed.
Do you think Tom feels good?
Tom Keene?
Tom Keene.
Oh, sitting down with the Fed president?
Yes, for sure. Honestly, this is a really interesting time because I think that there's a question of what sort of the tipping point is for them to go and cut rates again. And I think that that's sort of the key question. The balance is still, it's easier to cut right now than it would be to hike.
Well, let's think about why they were cutting interest rates. The global economy was weaker. Arguably, the global economy is looking a little bit better. It's not getting worse. That seems to be the takeaway from a lot of people at the moment, Paul. Yep. The data in Europe, the data in Asia, it's not getting worse.
Exactly right. And, there was a period earlier this year when particularly looking at Europe and Germany and German manufacturing really sounding some alarm bells. And we got a little bit of reassuring data coming out of Germany today on the manufacturing front. So that's so important. And then, of course, the trade, we're getting a little bit better rhetoric about the global trade situation between certainly between the U.S. and China, that may be helping global demand.
The Federal Reserve President of Chicago, then Charles Evans, sitting down with Bloomberg's Tom Keene at the Council on Foreign Relations. We can bring the beginning of that conversation to you now, right here on Bloomberg Radio.
With his commitment to Chicago economics and to Mr. Moscow, the research department there, and now on to his important duties. So let us dive in right now, and I, within the many speeches you've given, have to go to the speech in Frankfurt, Germany, where you speak about mid-cycle and about the dynamics at hand. Let's first define this new phrase. I don't believe I read it in Dornbusch Fisher Stars. What is mid-cycle?
Well, what the Federal Open Market Committee sort of identified in early, 2019 is that the, state of the economy and financial markets and inflation were behaving somewhat differently than we thought, going into the end of 2018. And so we had been raising the short-term policy rate, the federal funds rate target for, some time. We were never on a preset course for anything, but we were basically increasing the federal funds rate by 25 basis points every quarter. And then we got to the point where it's like there seems to be more uncertainty. There were a lot of things in play, the Chinese economy, and it looked like the path that we had expected, which in my own estimation would have called for probably 3 more rate increases in 2019. All of a sudden, that didn't look like that was appropriate. So in the middle of this, economic cycle, as we had been taking the funds rate, we thought, to a more neutral setting, and then just a little bit beyond that, we decided, I'm not even sure what neutral is anymore. I think it may have moved down on a short-term basis, and we need to make an adjustment so that policy would be, and I would say, moving from leaning towards a restrictive stance as a path to leaning towards an accommodative stance. And that's pretty much what I think we've engineered with our third rate cut at our last meeting.
Parse the distinctions of, as Vice Chairman Fisher would speak of, ultra-accommodative, where we are now within accommodative. I love the phrase hawkish rate cut. Please explain that to me when we get a chance. Hawkish rate cut? I
don't use language like that.
I know. It's
explaining somebody else.
Not appropriate for the Council on Foreign Relations. But within this is this path of accommodation that we're on right now. We're at a stasis point now, waiting for more. But how accommodative is accommodative right now?
That's a great question. At some level, monetary policy can be very detailed, very technocratic. You can look at a lot of data. You can try out different models. You can look for a robust response. Mm-hmm. But at some point, you're always basically searching for, do I want to be neutral? Do I want to sit in the background and just let the economy go? Let businesses do what they do very well, capitalism, and they employ people and they deploy capital and they put it in play when the government is behaving in a nice, responsible, value-added manner. Then the economy does very well and you sit in the background. And then sometimes there's a shortfall of aggregate demand, a weakness in, providing more incentives for credit intermediation is helpful, or the other way around. So, you're sort of trying to find out, are we neutral? Are we accommodative? And I would call the mid-cycle adjustment as one where we were clearly on a path headed towards slightly restrictive, historically not that restrictive at that point in an economic cycle, but slightly restrictive. And now, in my own mind, I was searching for something that was definitely accommodative, not hugely accommodative, but definitely on the accommodative side of neutral. And I think that neutral rate probably moved down. I mean, on a long-run basis, my assessment of neutral is 2 3/4%. And so we were still below that when we paused. And now we're at 1.5 to 1 3/4. I think we are definitely accommodative, but I'm not entirely sure that the short-run neutral funds rate isn't a lot closer to 2.
I want to get to that in a moment, but you mentioned the foreground right now, and there's times where a central bank can afford the luxury of being not in the foreground. Is the Central Bank of the United States of America right now too much in the foreground? Are we asking too much of the Eccles building?
No, I think at this point in the cycle, as we made that judgment to move towards something more neutral. And the short run neutral was moving up during that time. In 2014, we still had a lot of work to do, even though we started thinking about raising rates. But, I would say that policy is not that far off neutral. I'd say it's accommodative. That's a point where there are other factors, working. There's businesses are, working very hard to take advantage of the tax reform that they enjoy now to focus their business investment. Of course, business investment right now has been falling a little bit, so that's been a weakness. Now, there are other factors, the weak foreign growth, trade policy uncertainty, and things like that. So there's a variety of external factors that have acted to be restrictive, and so it makes sense for us to try to set that a little bit in a risk management setting. But basically, we're not in the foreground, I would say.
In I believe the Frankfurt speech you mentioned is one measurement here, 2%. With added to the 2% inflation added to the real R-star, and it migrates within your text from 5 down to 4 down to 2.5%. How R-starry are we? Are we slaves to this calculation right now?
Well, I said this is just a technocratic way of describing what I was just discussing about, are you accommodative or are you restrictive? And so, if you're completely comfortable in talking about, I think we want to be a little more leaning towards incentivizing, helping credit intermediation so people can take on some investments in consumer spending a little bit, then that would be, below this neutral rate. So you can go as technocratic as you want and say R-stars move down, the short run version of R-stars move down, and I'm just trying to catch up to it and be a little below that. But in my mind, we're just trying to be a little bit accommodative. And it's very artful. I mean, I could pull out all kinds of technical assessments, Lowback-Williams, other measures of that, but there's a lot of uncertainty around that, so we have to make judgments.
What's so interesting here, and I will speak of Michael Ferroli at J.P. Morgan, Mr. Bowders with us from Citibank, Ellen Zentner with Morgan Stanley, and others have a glide path down, a terminal rate and potential GDP that's under 2%. Let us begin with the idea that's not politically acceptable as well.
GDP growth.
GDP growth.
What's politics got to do with that?
Well, it has nothing to do with politics. We understand.
Well, you raised it.
But the distinction here is you people are dealing with demographics, nominal GDP, what you've been handed, and that's unacceptable to so many. And I would suggest the impatience of the president as well. How do you deal with that politics buttressing off you every day?
I don't feel alone in this. I think businesses have been dealt this environment, demographics, households have been dealt this environment, the ability of the economy to grow at some level. It's very simple. It's a matter of arithmetic. Growth in output is going to be equal to the growth in labor input hours plus what those hours are able to accomplish with the capital that businesses give them. That's labor productivity. That's just identity. And then you sort of look at what determines that. Labor hours, demographics are a big part of that. Well, the aging of the population, male attachment to the labor force diminishes as they get older. Female increases in labor force participation have run their course that led to very strong growth in labor hours in the 80s, but now are much weaker. And younger people don't have the same attachment to the workforce that they used to, so they don't work as much. Now, if you add on top of that the fact that you have a particular attitude towards immigration, which would add to labor employment and hours, then you've got a big hole that you're looking at. So that labor hours component is not going to be very large. We estimate it to be 0.5% each year going forward. 0.5%. Now, labor productivity, what are you expecting from that? Oh, I'd love to think that technology is going to improve labor productivity a lot.
With technology, you didn't mention technology in any of that discussion, which is fine, but now we are all living with technology. Does that lead to an inequality? Does that lead to a barbell outcome where technology advantages
Let me finish the low growth just to complete that thought, right? Because the labor productivity, you might kind of go, we got a tax reform, we've got disruptive technologies. We've got new digital technologies. We ought to see really strong growth. When did we see really strong growth? The 80s. In the 80s, we saw really strong growth. When we were growing, not in a decline, we grew 3.25%. Why was that? Labor input. Labor input was really strong during that time period. How about labor productivity? They call that the productivity slowdown period. We had great growth. low productivity growth. There was a whole bunch of things going, and it wasn't until 95 to 2005 that we really saw an acceleration of productivity. It's very difficult to predict when labor productivity is going to accelerate. It takes a very long time. Computers hit the factory floor in a digital fashion in manufacturing, durable goods in the late 90s. And so you get this, but it's very difficult to predict. You could hope for it to be really strong. You can hope a long time. I just don't know how to predict. We're predicting 1.25%. I think that's a pretty good, great rate of growth, and that's how I get to 1.75%.
Where's your nominal?
And that's what the economy is dealt that hand. We're looking at it. The politicians are dealt that hand too. If they want 3%, if they want 4 or 5%, then you got to think about public policies that are going to have an effect on that.
We call it fiscal space this year. We'll have a new name for it next year.
Labor, employment practices, all kinds of things.
Tell me about nominal GDP. With the lower demographics, with the new lower potential GDP, do we need to have a reset in our belief of the animal spirit? Do we need to are we going to be sustained under 4%, or could we do okay with current GDP?
Yeah, I don't spend as much of my time thinking about nominal GDP, as a total package, but think more about how you carve out the real GDP growth and the inflation. And I would say inflation has been on the light side. It's been under our 2% objective, and we've said that we should be pursuing a symmetric 2% objective. So that means, it'd be good if the FOMC clarified that a little bit more in some of our discussions about our long-run strategy. I think clarifying what we mean by symmetry would be important. To me, it means we should average 2% over some reasonable period of time. We should probably spend half our time above 2%, but we've spent our entire time below 2% since we called this out. So being willing to go above 2% is something that I think conservative central bankers have a lot of trouble with. I think the ECB historically has had trouble with that. The Bank of Japan has really had a problem with that. And so if you limit yourself, if you say our objective is 2%, but you really act as if it's a ceiling, that reduces the monetary policy space that you have when you need to provide more accommodation during a downturn. So that's why I think it's important to achieve our 2% symmetric objective.
And Evan's speech is responsible until it's not. And the words come out here. I have mild comfort with 2.5% inflation. Perseverance is crucial. A powerful, full-throated commitment to this asymmetry you speak of. And it all centers on outcome-based monetary policy. Let's dive into this. Olivier Blanchard and others many years ago said, look, we need to really pop inflation. We need an aggressive approach here. You follow on as a public official with really a strong statement that we have to jumpstart this search for a higher level of inflation. Explain what a powerful, full-throated Evans commitment is.
So you've interwoven two different policy proposals.
I would never do that.
So I believe you were probably referring to Olivier Blanchard. I think he was research director at the IMF, and he sort of said, there's really, because what we have said is, on average, the Federal Reserve, when we go into recession, we cut the short-run policy rate by at least 500 basis points, 5 percentage points and more. If we start at 2.75%, we can't do 5 percentage points, and so we don't have a lot of ammunition and capacity. That's premised on a real rate of 0.75 of a percentage point and 2% being at 2% inflation. If you don't get to 2%, you start lower than that. If you had a higher inflation objective, and this is where Olivier Blanchard was musing, if we had 4%, 4 plus a 1% real rate, that gives you 5 percentage points, and then you've got more capacity. Central banks have sort of settled on 2%. People get very nervous when you talk about 2.1% or more than that. But at any rate, so I think most people have backed off. In our own long-run framework, Chair Jay Powell took off the table resetting the inflation objective before we even got started, that type of thing. So when you are trying to hit 2% symmetrically, I think you need to hit it. And so if you say symmetric, we need to say what we mean that is. If it's averaging, that just means that some of the time you're going to be above it. And since we've been down at 1%, and 1.5%, 1.25% for a very long period of time, 2.5% just doesn't seem that outrageous, except that there are an awful lot of people who kind of say, Soon as you go above 2, you're probably headed to 18. I don't know, a big number. And it just sort of presumes that it's not possible to operate in a parallel environment around that 2%. We need to discuss that. We need to communicate what we mean. I'm comfortable with 2.5% inflation, and in fact, trying to get to 2% with momentum, full-throated, harder than many would try, to make sure that we actually get there, head for 2.5%. Half the time we don't get to 2, so maybe that would get us to 2. And then maybe the other half we go over a little bit. You know, when I get to 2.5, I'm definitely going to be, look, what's my forecast? Am I expecting to go to 3? Are there special circumstances that are going to make us go further? It is very difficult to generate inflation in the current environment. And in fact, we've just agreed to tax reform and a fiscal policy and government spending that increase the national debt by $1.5 trillion over 10 years. That's not enough to get inflation going either. So I think we need to work harder to understand this and be aggressive.
I was talking to Michael McKee this morning about the outcome of your Frankfurt speech. How do we affect the, as you say, momentum, the physics to get above 2, even 2.5, 3 months of 2.7? How do you affect that process?
I'm trained as a monetary economist, and most of the time your training is, inflation is the monetary authority's concern. If you're Paul Volcker, if you're G. William Miller back in the 70s, and you kind of go, or Arthur Burns, well, inflation's double-digit. I can't do anything about that. No.
Well said. We did it on the way down.
You can do something about that, and Paul Volcker did that. It's the responsibility to deal with that. If inflation is under your objective, it's your responsibility. If you don't understand all the other factors that at work to make you think low rates are accommodative, when in fact they're actually still restrictive if you're not hitting your 2% inflation objective. Do you need to drive the vector
on the interest rate lower? Jan Moyes with that summer piece out of J.P. Morgan, not a forecast, but a model of how you bring the 10-year yield down. Is that where we could be heading as we affect an Evans-like 2.5% inflation jump?
So I think I think there are a lot of details. At any point in the process, we could have a discussion like that, and I'm willing to have a discussion. But at the moment, I'm thinking more about strategy and how you go about operationalizing to get to your strategic goals. And I think an enormous part of it is communicating. We are headed for symmetry. We are willing to go over. We must go over 2%. If we are going to average 2%, you've got to be above 2% when you've been below it. When you think about the effects of the zero lower bound, we now call it the effective lower bound, I guess, because some people think we might go to negative interest rates. I think zero lower bound is probably more accurate. But when interest rates fall a lot and we're at the zero lower bound, our expectation is inflation is going to be pretty low. Then we get out of this in the second half of the cycle. We get back to we should be there now. And then if you're going to average 2, you got to be above 2 for that second half. Well, maybe you need to, be targeting something more like 2.25, 2.5 on the second half of an economic cycle just to get to an average 2%. Talking about that strategy, making sure that everybody is totally comfortable with it or not, and admitting what your operational approach is, but communicating what you're going to do after being very clear about that and not kind of getting nervous and twitching when you get to 2.1 or 1.9. Because I confess, I'm about as outspoken as anybody in terms of I'm okay with inflation above 2. But then I start talking about inflation at 2.2 and maybe my voice breaks a little bit. I think it's part of the DNA of central bankers, and we really need to break out of that if we're going to be able to achieve 2% symmetric inflation.
I mentioned Gerald Ford today on television. I realized nobody on my staff knew who he was. What about whip disinflation?
Former President of the United States.
Yeah, whip disinflation now. I mean, that's really the strategy we're talking about. How big a constraint is $1 trillion deficits? You mentioned the fiscal response. The vogue this moment is fiscal space, whatever that means. Are you constrained by the fiscal challenges of the nation?
mean, as we look at conducting monetary policy, you do it over a particular horizon that, you can have some effect on 3 to 5 years. You look at that forecast, there seems to be no constraints from accumulation of fiscal debt. I would expect that to emerge from very high Treasury rates, long-term bond yields. That is not what we're seeing, even though we've seen a little bit of a turnaround. They're very low right now, so there doesn't seem to be any pressure there. This is a different world than the 70s. There's an intense desire for safe assets. People used to kind of go, geez, have you noticed that the German bund is negative? Who in the heck would want to own the German bund? And I say a lot of people. Because most people who see the negative yield don't see the point that the price is very high because people want that. So our low long-term interest rates indicate that people like holding that. There's a demand for that. You could argue that there's, a need for more supply, and this would be one way for it, but it doesn't in any way, as I can tell, constrain our forecast.
Carnegie Mellon, with the heritage of Alan Meltzer, Marvin Goodfriend there as well. He wrote in Jackson Hole about negative interest rates. There was a modest uproar about that paper. Your thoughts on the experiment of negative interest rates, and with that, the idea of Japan to Europe to a U.S. slowdown. Should we have a fear of a trajectory towards negative interest rates in America?
I think central banks that have used negative interest rates have found them to be helpful for them. I think that just take the ECB. The ECB and the Bank of Japan, they came later to the broad asset purchasing programs that the Fed had embarked upon with our open-ended QE3 in September 2012. We did quantitative easing before that, but we did the open-ended in 2012, and that sort of changed things. I think forward guidance was helpful, but the combination was useful. The Bank of Japan did that, ECB did that, but they also added negative interest rates. So I think that helped them a little bit. If you look at the level of negative interest rates, they sort of pale in comparison to the actual need for accommodation. Back in 2009, according to many interest rate rules, the Federal Reserve should have been seeking to set the nominal federal funds rate at about minus 4 percentage points. That's what the Taylor rule, straight reading, would have indicated. We can't do that because, we've got zero. Minus 70 basis points is probably a very low down payment on something like that. Other policies would have been, at some point also fiscal policy and other policies, I think that the central bank has to address inflation and has to help the economy as much as we can. But as, long-term Treasury rates go very low, if you're concerned about that, that seems to indicate that it's not very expensive to run expansionary fiscal policies, and maybe the trade-off there is better. So negative interest rates, I don't think that we can achieve enough with that tool. I worry that financial institutions and savvy investors who would find themselves at risk would organize their resources in a way to make their exposure more limited. That would be a natural thing for them to do, and so I would expect it would be even less effective in the future. I would much prefer to get our communication strategy more in line with achieving our objectives.
Financial institutions and savvy investors have gone after you guys over, as you mentioned, the balance sheet, and the critics would say quantitative easing, and the new quantitative easing that's under process now. Bill Dudley, of course, with the firestorm, wrote about this with Bloomberg. Vice Chairman Clarida spoke to me the other day and made clear this is not a new QE bout. Just lightly touch, given the time, on the repo uproar and the efficacy of your solution away from being quantitative easing forever.
Sure. So we spent a long time at the zero lower bound. We've got a very large balance sheet. We went up to $4.5 trillion at some point, and so it was clear that we needed to bring the size of the balance sheet down. There were a lot of people who kept telling us, yelling at us, that we should have a lower balance sheet. At the end of the day, we're going to do what we think is best, but reducing the size of the balance sheet was always part of our plan. And so as we embarked upon a plan to reduce the size of the balance sheet, at some point, and you realize this very early on, how big is the balance sheet going to be when you settle down and then start growing it again? Because cash starts to grow in the size of the economy, the balance sheet's going to grow. And so we had discussions about that, and this is going to have an implication for when short-term policy rates all of a sudden might start to tighten and all of that. And so, we made a judgment that we could reduce the balance sheet to a certain point, and then in early September, we kind of learned that looks like the markets need, on a short-term basis, because of tax policies where checks are written, funds are put off to the side and aren't used for repo and things like that, and other things. There wasn't as much liquidity there. You've also got a change in regulatory policies so that some of the banks and dealer brokers that previously were in the business of arbitraging these rates between repo rates and other depository rates, they might provide that, and then it's kind of like, the regulatory incentives now aren't as attractive for that. So we kind of decided ultimately that the balance sheet probably needed to be larger than where we were at that time, and so we embarked on buying $60 billion a month at the moment, short-term T-bills. So this doesn't add duration to speak of to our balance sheet. Right. It's not like the QE where we were buying long-term assets. And so it's in that sense, this is not QE. This is just trying to provide liquidity, and we're going to be searching for the right level of liquidity so that we can hit our funds rate target, keep the funds rate within the target range, and not have it go above that because of a lack of arbitrage with other treasury rates.
One more question, and then I'm going to go to questions from the floor. You have a wonderful audience here today. Just as a warning, the first question will go to the gentleman from Cedar Rapids, which I haven't talked to before this, but we'll figure out who the gentleman from Cedar Rapids is here in a moment. One final question. This is all great, and it's great for the elites, and it's great for the suits and ties. But the bottom line is America's savers have been crushed by this collapse of the real interest rate. And for even that matter, the nominal interest rate. Speak to the savers out there. Speak to the have-nots of investment who haven't participated through all of this economics.
Yeah, I talk to somebody, every morning before I go to an FOMC meeting about this exact problem. My wife is always telling me, make sure that you don't cut that interest rate. I need a higher savings rate. You can see what effect that's had.
Riley, could you get her on radio? We'll want her FOMC, Mrs. Evans.
So that's definitely the case. One thing about monetary policy, when you're raising interest rates, there are some people who benefit from getting higher interest rates. There are some people who don't benefit because they've got higher borrowing costs and things like that. So it's extremely natural for us to, be paying attention to that. But at the end of the day, it comes down to how the economy is going to do. I think that everybody's going to be better off when we pursue monetary policies, even when that means low interest rates that are market determined. I mean, we set this short-term policy rates, and then the market determines all the other rates. And if it's not in line with that, like if there's fiscal policy problems, the yield curve will steepen and things like that. So we can't do everything that's golden. But in this case, I think getting the economy going so that the job market is very strong, labor markets are very strong. I think the consumer right now is supporting the economy in an enormous way, in a way that the business side at the moment is not, even though the architects of tax corporate reform indicated it should be stronger than that. And
did that work out?
I think that we're still waiting to see. Well, there's so many other things going on with
Brett Setzer had a great thing out on Twitter today, really questioning the efficacy of tax reform.
But at any rate,
I don't want to get in that much trouble right now.
But I think that getting the economy going is going to help everybody, including savers.
In this room a number of years ago, he was with the IMF at the time. John Lipsky talked about macroprudential risk. We'll let him have the first question today. Dr. Lipsky?
Thanks. Good morning. Morning, Tom. Good morning, Charlie.
Good to see you, John.
Quick question. Obviously, the Fed in recent, the FOMC in its recent pronouncements has paid a lot of attention to international economic and financial developments. Does that represent a heightened awareness of the influence of international forces on the domestic economy and hence on on Fed policy, or is this in line with previous practice? And secondly, it was many had suggested that with central banks, all key central banks focusing on the same inflation target of 2%, that would bring about an implicit coordination of monetary policy among key central banks. Yet today we see substantial differences in actual short-term rates and uncertainty about its influence on the value of the global value of the dollar. Has that agreement on a common inflation target actually brought about coordination of international monetary policy?
That's really interesting and quite complicated, because, as you point out, it sort of gets at foreign exchange values. We could all agree on different inflation objectives, and that in principle would have a path for how foreign exchange rates would evolve smoothly over time if everything went on a steady state fashion. So it gets complicated pretty quickly. But I believe that on that basis, more clarity for all the central banks as to what their objectives are, the weights that they give to inflation versus other objectives, which in most of those cases are secondary to the inflation rate, but they also care about the economy and also probably financial stability to some extent. And so the more we all understand and are in line in the sense that it's normal, we do this too, so it's more likely we'll understand that. I think there's better understanding of the policies that everyone would pursue to achieve that. I wouldn't call it coordination. There is, better than I do, there's lots of conversations. People get together in Basel 6 times a year at least, and other places around the world. And so there's a sharing of information about what's going on that I think is helpful for everybody to achieve their objectives. And, if it's not cooperative, at least it's non-rivalrous as best it can be. I think in terms of the international situation, I don't think things are different in terms of a different policy reaction. I think it's a different moment in time than many other times where, Europe is definitely slowing. Brexit is a huge uncertainty, even though it looks like now things could play out in a more careful fashion. But it's really hard to guess that. And China is a big uncertainty, and then international tariff trade discussions, uncertainty around that certainly changes things. So, in terms of the mid-cycle adjustment, I would say this is very much a risk management approach to ensuring that the U.S. economy is positioned as well as it can be for a little more noise from wherever it could come from to the economy to help support it. Our adjustments have not been anywhere, large enough to change the dynamics substantially. If there was a big negative shock, we'd have to respond, and I would expect other countries would have to. So I think this is sort of the normal response, but the moment in time is really, quite different in large events.
You're channeling there Frank Knight, Chicago. I'm going to say 1921, it may be 1923, but parse right now. Chair Powell's out there at the press conference, and he has to parse the risks you measure versus the tangible uncertainties that are out there right now. Expand a little bit here on how uncertain those uncertainties are. I sound like Muhammad Al-Arian, I'm sorry. How uncertain are those uncertainties right now, those unknowns?
They're uncertain. They're big. Before breakfast, we were talking about a few things, and we mentioned Rudy Dornbush. And while I never met him myself, I have seen a number of scholars who studied with him. He's much beloved, and Paul Krugman attributed, but others too, to Rudy Dornbush, this idea from international crisis that you can see something really bad happening and it unfolds in a very slow fashion, and you just think that it has to change the world, and it doesn't, and it takes longer than you can imagine. Then when things really hit the fan, it happens much more quickly than you ever, expect. And so there's this nonlinearity. You can call it 90 and uncertainty in the sense that it may never have happened. You can't predict the timing of it, but there are these factors out there, and unless something offsets them or somebody else gets their act together, it, doesn't look like it would be helpful, but it might not occur. That's really hard to address.
Ellen Zentner, please, the chief economist of Morgan Stanley.
Hi.
Morning, Ellen.
So I thought the Evans rule original was brilliant because
unemployment or rates will remain low at least until unemployment was below 6.5%. But you had to guard against financial stability, and that was important, right? So as long as inflation isn't projected to move above 2.5%. So if you think about, you all have been discussing inflation framework. What would an Evans rule look like today that would aim at getting inflation higher but have some sort of knockout clause for financial stability?
Yeah, so when I was arguing for forward guidance, it was a little bit simpler in the following sense. We were stuck at zero on the funds rate. We had a lot of discussions about, the committee was divided. Some people wanted to raise rates, sooner than certainly I thought, and the unemployment rate was high, and you had a discussion about, well, what's the natural rate of unemployment? What if it's 7%? If it's 7%, maybe we need to start raising the funds rate. Now we think it's more like 4.3%, so you talk about uncertainty. There's a whole lot of that. And it was a little easier. I thought we were trying to stifle premature expectations of a Fed tightening. Now, if you're going to do it, we've got the funds rate target at 1.5 to 1.25%, and so now you'd be trying to craft something where you'd indicate we're going to continue to maintain an accommodative stance of policy. Maybe that would be keeping the funds rate where it is now until, and then some objective is stated. So my colleague Neil Kashkari, I believe, has not been shy about sort of saying, we should have inflation at 2%, and maybe one thing to do would be keep accommodative policy until inflation gets to 2%. That could be one example of that. It gets to be, it was challenging. It was kind of easy then because unemployment was so high and 6.5% was such an achievable objective. You just kind of knew we should blow through that. You get to 2% and you kind of go, is it sustainable at 2? Did we just kind of touch 2? Should we have 6 months at 2? You'd have to craft something like that. And then I suppose, I know I have a number of colleagues, the committee, judging by my colleagues' speeches and our summary of economic projections, the committee's fairly well divided. A number of people have mentioned financial instability, risks that if there was more leverage taken, more frothiness in markets, then maybe the low funds rate target would be inconsistent with that. I don't subscribe to that argument myself because I think that that's trying to do too much with a single tool. I think our supervisory and regulatory policies ought to be ensuring that any damage that comes from leverage, first off, we don't get to an over-leveraged position, and also that we're ready with capital.
Can you reflate without releveraging? Can you reflate without releveraging?
Well, we have to talk about the circumstances. Are we talking about a 2009 period? And I think a lot of it comes down to capital in the banking system. And at the moment, it looks like we have, quite a lot of capital. We've added more and better capital, and the regulatory environment has shifted just a little bit to allow, more dividends and things like that a little bit. It comes down ultimately during a financial downturn when banks are rebuilding their capital. When do they think they've got as much as they need to lend freely and intermediate credit in all the right places? And that's one of those things that I think always takes longer than most people appreciate. And I think that was a big part of coming out of the financial crisis this time. And also, financial institutions thinking about how their business model might change over the next 5 and 10 years. So it gets complicated pretty quickly. We've only got one tool. There's an awful lot of objectives out there. And if you want to put a little political spin on some of these things, it just, you I only say that because you did. But if you did about, you'd like more growth and things like that, you have to think about sustainability and all of that. So it gets complicated very quickly.
Well, let's go to Willem Bouder here, the path from Yale and James Tobin with Citigroup. Willem Bouder.
Thank you very much. You mentioned that the standard Taylor rule in 2009 called for roughly minus 4%.
I think so.
Policy rate, something like that. Admittedly, wherever the effective lower bound is, it's bound to be higher than that. But it doesn't explain why the margin that is there technically wasn't used by the authorities. Now, the question is this political, or is there a belief that there's a reversal rate which hits at zero.
You mean why we didn't take it into negative territory?
And the next time of asking, the next cyclical slowdown, you will be back at effective at a zero lower bound. And why not plot further? Is there any particular reason for that?
That's a good question. Certainly, the Fed was ahead of the other central banks in 2008, 2009. It started in the U.S. and our problems were worse initially. I think there was, I really can't recall any substantial discussions of negative interest rates during that time. It just weren't something that seemed to appeal to many people. Now we have experience in these other central banks, and so you could imagine trying that. Like I say, I think maybe you could get 70 basis points, and whether or not that would help, maybe. I frankly think that if we had a longer discussion about asset purchases and open-ended QE3, and you can probably, every side can find studies that indicate powerful, not really so powerful, and event studies being what they are, that's a very difficult thing to measure. I continue to come down on the side of it really came down to communicating the signaling channel. We were going to do whatever it takes. If you look at what Mario Draghi achieved in 2012 by saying we'll do whatever it takes and it will be enough, what did he do? He developed the OMT. How many OMT bonds did they ever issue? None. Showing your willingness to do something that previous versions of the head of the central bank weren't willing to contemplate goes a ways. Following through and delivering, though, is really important. So constantly working on that. If negative interest rates were a helpful signal, and I think that's part of what it is, because they keep backtracking on what reserve levels are actually being hit. If anything, you kind of want to hit more of it and incent. If you lend out more, then you get more credit or whatnot. So the design is challenging.
This gets to courage, and as you mentioned, the perseverance needed to reflate above 2 or 2.5%. You say, I want to circle back to the single idea. What is the mechanism of that perseverance, that courage that we need?
Well, I think it's very important that the central bank have a sufficient level of independence and be perceived as independent. So I think whenever you start worrying about the actions that I take through increasing my balance sheet might not be perceived well by a variety of authorities, that tends to make you wonder about that. Being able to undertake these very strong actions and be accountable, so go and testify to Congress and explain it to the public and everybody. I'm not saying it's not without risk, because we tried things which had not been tried before, to my knowledge, and they were unpopular for a lot of people. And then you've got the saber question. I have taken the saber question many, many times. It's still there. It will always be there. Some people benefit from some policies and other people are disadvantaged. When when Paul Volcker had to bring double-digit inflation down, the unemployment rolls increased hugely, and that was part of the cost. And so monetary policy affects people differently at different points in time. Sir?
Thank you, David Braunschweig. You alluded to the conundrum of lack of productivity growth in the 80s. How comfortable are you with your metrics and your ability to appropriately measure productivity in services, which constitutes the lion's share of our economy?
Yeah. No, those are good points. Productivity is one of the most difficult things to measure. Services, in particular, is very difficult. I take those points. I think that no matter how poorly they may be measured at the moment, I believe them to be measured on a basis that is consistent with the way the national income and product accounts are measured. I say that only because if we pick a benchmark, we can pick a benchmark, GDP growth, real GDP growth. I'm trying to explain to people why I think 1.75% is the rest growth rate for the economy. I do not think it's 3%. inflation has not been growing very strongly. Part of this is going to come down to if inflation were growing very strongly, and we're at 2.25% growth and inflation is growing very strongly, we'd have to have more restrictive policies. I would guess that would reduce economic activity, and so that would make you wonder about what productivity is. Now, if productivity was really strong, that presumably would reduce unit labor costs, and that could be consistent with the lower inflation. So, I look at inflation and I kind of go, if we can hit our inflation objective and get that right, we look at real GDP, we look at all the indicators of productivity, and if they're aligned and seem like they're doing well, then I call it a day and I'm done. The research staff looks at productivity and tries to find out if there's new insights from the services. It's very important, there's no doubt about it, but it's the big inflation and how's the economy doing that capture most of my attention. Yeah, I'm sure that some sectors of the economy have very strong and thriving productivity growth, but when you put it all together, and we've also got the age of disruption too, and so you see spectacular productivity gains in other areas that completely decimate, the legacy producers, and that gets averaged across that. So you kind of people usually want to pick out the winners and look at the strong productivity growth, and we've also got the laggards that need to be dealt with.
To this wonderful question.
It's a hard question. I can't do justice.
It's a hard question. There's no answer there. I was speaking with Alan Meltzer in Pittsburgh. I was lunch with Alan Meltzer in Pittsburgh. We got this raging argument about should we aggregate.
Alan Meltzer? You upset Alan Meltzer?
I upset Alan Meltzer at lunch. It's hard to do.
Yeah.
But we had this raging debate about John Edwards and Two Americas versus the desire to aggregate, or as you say, put all the data together. Do we need to be more respectful of not putting all the data together and worrying about 2 or 3 Americas, the haves benefiting from the new productivity and the have-nots left behind?
I have a lot of respect for Alan Meltzer. He was a esteemed professor at Carnegie Mellon when I was there. I didn't always agree with everything, but that's the nature of economics. Yeah, I don't know. I think it's, the state of the economy is really hard. I was falling back on my meager economics training and macroeconomics. One of the first things you assume is that the distribution of activity just isn't that important. Income distribution,
right?
High income, low income. It's just a simplifying assumption, but it seems like the level of income inequality is really very large at the moment, and the nature of productivity enhances returns to education and certain skills lead to outcomes like that. And I think if you're, wondering about appropriate levels for economic growth that benefit a large swath of the population, you have to be thinking about how you can address some challenges that aren't in my economic models to help more people benefit from that. So, is that 2 Americas, 3 Americas, the data? You can kind of try to do the uniform macroeconomist viewpoint that it's GDP and that's all I care about. But there's way more, going on. And this comes up in the economics profession now, and the lack of diversity and women in the profession, and do we find ourselves looking at certain questions more and deciding that it's perfectly fine because of that? I really don't know, but I know that when I have more people in the room giving me new perspectives on how things should be playing out, I usually end up in a better place. So.
Chicago Fed President Charles Evans there speaking to Bloomberg's Tom Keene at the Council on Foreign Relations. A really interesting audience as well. John Lipsky asking a question a little bit earlier, the first Deputy Managing Director formerly of the IMF. Ellen Zentner of Morgan Stanley in the audience as well as Mr. Bouter of Citigroup too. That's Charles Evans then, Paul Sweeney, and I've got to say, we started this conversation about an hour ago. That's a Federal Reserve that sounds pretty unified compared to maybe 6 months ago.
Yeah, I think they feel like the economy is, Dr. Evans just was mentioning that Tom Keene is in a pretty good place. The consumer is in a pretty good place. And I think they feel like what they've done with rates this year has been pretty effective.
Pleased to say that Lara Rain joins us now. She's been listening to the conversation, FS Investments Chief U.S. Economist. Lara, let's start there, shall we? It was a Fed that looked really divided even just 2 months ago. Your thoughts on the unity we now have at the moment?
I think that it's a unity based on sort of a tentative détente that because right now they've sort of gotten themselves to a place where they feel like they've really compromised across a variety of views. I think if you saw solid U.S. economic data, but a really volatile financial market, and some folks on the Fed started talking about cutting again, you would still see that same voice of dissent from people who feel like we really should be more focused on the core fundamental data instead of volatility in financial markets.
So, Lara, based on kind of what we heard from Dr. Evans along with Tom Keene this morning, is it your sense that, the market's pricing in essentially one more rate cut sometime next year? Do you think that's kind of where the Fed should be?
I think the Fed is going to work very hard to sell a balance of risks, an evenly balanced level of risk going forward. But I think the reality is knowing that, some issues like trade may not be behind us completely. And the fact that, everybody has some type of, most forecasters have some type of slowdown built into next year. I see the risk that the Fed may cut one more time next year. But I think this tinkering is difficult, and I think that's perhaps the lesson that we've learned from the last 3 rate moves. It's hard for them to pivot, and it's hard for them to try to micromanage the economy with interest rates. It just doesn't work very well.
So as we think about 2020, it seems like the odds of a recession are declining across the board. What is your view of a potential recession in your outlook?
Yeah, I agree. I have not had a recession in 2020 in my outlook. We're going to get a recession one day, but for the next year and a half, it's not in my forecast. I do think that we're going to experience a period of sluggish growth. And part of that is because I'm a little more anxious about uncertainty rising as the election really gears up into full swing. But I think it's important to remember that we could get even a quarter of negative growth. We've already had that during this expansion. I think full year we're going to be around 1.5 next year. It's going to feel pretty sluggish.
Is there a sense that 1.5%, 2%, could be something lower for longer type of thing? It could become the new normal, at least for the next several years. I know we're hearing some concern about that.
Well, that's certainly something that Evans spoke about at length today. He sort of talked about how he got to his estimate of what he called a resting growth rate for the U.S. economy of 1 3/4. And that seems very consistent with a lot of other estimates, especially because our labor force growth is just very constrained. And we can try to pull people off the couch, get people, more engaged in the labor force. But at the end of the day, we're just not generating the new labor that's going to give us stronger growth gains. I think he really dodged the question, and rightfully so. It's not a road I think that he wants to go down of whether or not that's going to be politically palatable. But at the end of the day, I think the Fed realizes they're limited in how much they can impact that. They're sort of dealing with the economy that they're dealt. And it's not just the Fed. It's politicians, it's households, it's everybody. I think that he reiterated that.
So, Larry, you mentioned trade. That continues to be an issue for this economy. It appears that both sides, China and the U.S., are making some progress, hopefully maybe even get a deal signed, maybe a phase 1 type of deal signed next month. How important is getting, even if it's just a phase 1, kind of what I've been calling a light trade deal, getting that signed? How important is that?
I like that phrase very much. I think we've been also talking about how a trade deal, any progress on trade is a positive. So, and markets, I think, are certainly reacting to that. You're seeing equities at all-time highs. I think we really need to think about 2 things, however. One is that, the bilateral trades good issues are easier to resolve than all of the other factors that need to be addressed with China, like cybersecurity, the 5G hardware, even things like freedom of speech and, military, issues. I think those are going to cause uncertainty with these two parties for many years to come. And the second one is that China looks like it was already slowing down well before the disruption of the trade war that we got several years ago. So I think China's economy is facing a slowdown. Yep. They've got their own financial issues to work through. So slower Chinese growth may be something that we're stuck with, whether or not we have a trade agreement or not.
Laura Raim, thank you so much for joining us. We really appreciate your insights into what we're seeing in the Fed, what we're seeing in the economy. Laura Raim, FS Investments Chief U.S. Economist, here just with her thoughts on the conversation Tom Keene had with the Chicago Federal Reserve President at the Council of Foreign Relations. This is Bloomberg.
At the Bank of Antandek, mortgages are on the menu.
I was in the chippy last night and it hit me.
Go on.
We should give all our new mortgage customers £1,000 of spuds.
Potatoes?
Yeah, jackets, roasties, dauphinoise. I mean, what's not to love?
Hey, yeah, we could call it Mashback.
Genius.
Meanwhile, at Santander, they're giving their customers £1,000 cash back on selected first-time buyer mortgages. See what's possible at Santander.
Lending subject to status and criteria. Cashback given on completion and repayable if mortgage closed within 2 years. Offer can be withdrawn. Your home may be repossessed if you do not keep up repayments on your mortgage.
This is the sound of Helen and Peter, hiking to the fairy tale fortress high above the winter wonderland below. Or it would be, if they hadn't stopped at the first beer house they came to. There it is, Helen and Peter. There's your incredible. Fly from London Gatwick to Salzburg from £29 each way. With British Airways, incredible is within reach. Terms and conditions apply. Limited availability and dates. Fare quoted is each way based on a return. cba.com/Gatwick for details.
London. Switch to Vodafone, the UK's best mobile network, and Be Unlimited, because the best phones deserve the best network and our new unlimited data plans. The future is exciting. Ready? Vodafone.
Max download speeds apply to unlimited data. Best network as voted by readers of trusted reviews. Terms at vodafone.co.uk/unlimited.
Financial capital of the world, 24 hours a day at Bloomberg.com, on the Bloomberg Business app, and at TikTok on Twitter. This is Bloomberg Radio. This is Bloomberg Surveillance Economics.
The Federal Reserve's independence is crucial.
Central banks should be prepared and not presumptuous.
Finance.
In order to grow, you need to innovate.
Global money doesn't like uncertainty.
Investment.
I think the issue in the market is really more about the possibility of a recession in the next couple of years.
I do think we need to get back to where we have always been, the American dream.
Bloomberg Surveillance with Tom Keene and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from New York City to our worldwide audience. We're here from the Bloomberg Interactive Brokers studio. We spent this the last hour listening to Chicago Fed Reserve Bank President Charles Evans. He was speaking with Bloomberg's Tom Keene, talking about the Fed and the economy. And again, I think the Fed can rightfully take a little bit of a victory lap here as it seems to be negotiating a fairly decent soft landing here. The rate cuts may be done for this year. Maybe one more next year is what we heard from Dr. Evans. Looking at the screen here right now, we have green on the screen, a little bit of up in the market. S&P up 3, the Dow up 33. Let's see where the real action is. We turn to Bloomberg Stocks editor Dave Wilson. Dave, what are you looking at this morning?
Well, you've got to start with Uber Technologies today. The shares are down 5.5% in early trading. Now, the ride-hailing services insiders can sell hundreds of millions of shares as of today that were locked up after Uber went public in May. And we've had people tell us that 2 million shares were sold in a block trade at $26.90 each. That's down 4% from Tuesday's close. Uber's fallen further, now at $26.46. And you know what's also at that price? Altice USA. It's down 15.5%. Whoa. The cable company's third quarter revenue missed estimates by the most since it went public in 2017. Profit also trailed projections. And then you also got Match Group down 13%. This is a company that owns Tinder, Match.com, and other online dating sites. They gave fourth quarter forecasts that were lower than analyst average estimates in a Bloomberg survey. CFO Gary Swidler said citing legal costs and investments in an interview. We should point out Match Group, majority owned by IAC Interactive Corp., and that stock's down 10.5%.
That's Barry Diller.
Indeed it is.
Right.
Okay, so those are their bad news stories. Let's turn the tables. Look at HP. It's up about 8.5%. The maker of computers and printers may become a takeover target for Xerox Holdings, according to the Wall Street Journal. The report said Xerox is considering a cash and stock offer that exceeds HP's $27 billion market value as of yesterday. I say over because that's way over the market value of Xerox itself, just above $8 billion at this point. So that really tells you something. Xerox down 4% in early trading. Walgreens Boots Alliance up 1.5%. The drugstore owner is higher for a second day as it considers what would be the largest ever leveraged buyout. People familiar with the matter said Walgreens has held talks with KKR and other private equity firms. And in that business, you have CVS Health up about 3%. The pharmacy, drug benefit, and health insurance company posted third quarter earnings and revenue that beat estimates, and CVS raised this year's profit forecast. Humana, which competes with CVS in the insurance business, up 3%. They raised their full year earnings outlook after third quarter profit beat projections. Humana also lifted an estimate for new subscribers to its Medicare Advantage program. Back to earnings, CNH Industrial down 1.5%. The farm and construction equipment makers' product sales for the third quarter missed the lowest estimate. You have CenturyLink down 4%. Now, they're coming out with earnings after the close today, and they were cut to sell from neutral at Guggenheim in advance of the results. The firm said investors would have been better off if the company had scrapped its dividend rather than cutting it by 54% as it did in March. Coty's up 4.5%. The cosmetics maker was more profitable in the fiscal first quarter than anyone was expected. Earnings beat estimates. Devon Energy's up 5%. Third quarter profit and revenue at the oil and gas producer fell less than analysts predicted. And one more for you, Bloomin' Brands. This company owns Outback Steakhouse and other restaurant chains. It's up 8.5%. Bloomin' Brands said it's looking at a possible sale of the company along with other strategic alternatives.
That would be the Blooming Onion.
Indeed, it would.
Okay, people are still going to the restaurants. That's certainly what we're seeing. A strong consumer. They're still spending money at the restaurants. Bloomberg Stocks editor Dave Wilson, thank you so much. Well, let's go to that Walgreens Boots story that Dave was just reporting. A big potential LBO. Think back to the 80s. We're talking here. Here's a company, Walgreens Boots Alliance, $55 billion equity market cap. They got a little more than $15 billion of debt. So we're talking an all-in enterprise value about $70 billion. So this is size, much like we saw back in the 80s and 90s. So give us a breakdown of this deal. We welcome Jonathan Palmer. Jonathan's a senior healthcare analyst at Bloomberg Intelligence. He joins us here in our Bloomberg Interactive Broker studio. So, Jonathan, this is a huge deal. The dollars are big. The bankers are going to get paid again. Why would Walgreens consider this deal?
Well, it's interesting you brought up the corollary to the 80s because there's the CEO of Walgreens, Stefano Pessino, is kind of a larger-than-life figure in this space. I mean, he owns 16% of Walgreens. And so that's maybe one of the reasons that we might see this deal. There's a lot of headwinds in the pharmacy business. We have Amazon moving in on the retail side. We have insurers pushing on reimbursement. We have, potentially Medicare for all, coming down the pipes if the Democrats win the election. So, it's an interesting time to be discussing this deal. I mean, my personal view is that the probability of it's probably pretty low just because of all those reasons.
Interesting. So Walgreens Boots, let's take us back. This is a company that was, a merger between Walgreens and here which is big in the U.S., and then Boots, which is UK based. So tell us about what this company is today.
Sure. So you have to actually go back a little further. Stefano Pessina, the CEO, actually started a company called Alliance, which is a wholesaler in Europe, and basically grew that to cover all of Europe. And then he and KKR took over Boots in the late 2000s, I think 2007. Fast forward to a couple of years later, and Boots Alliance at the time and Walgreens approached each other, and over a couple year timeline, they put together a deal where they merged to create this global pharmacy company.
So this guy, Stefano Pessina, obviously it seems like a serial deal maker in this space. So if this deal were to go and happen, where does Walgreens Boots kind of stack up in terms of market share and leadership in the market and the competitive landscape?
So in the U.S., it's really a two-horse game. Maybe three if you want to consider Walmart. But it's CVS, Walgreens, Walmart, Costco. Those are the big pharmacy chains. And so CVS and Walgreens each have about 20% market share. CVS has stacked their chips on buying an insurer, Aetna. Walgreens has taken a different approach and said, we're not going to move into the insurance business. We're going to focus on retail. And they've done a ton of partnerships deals. So they've partnered with companies like LabCorp, companies like Humana, some of the delivery services. They're really focused on retail. And that kind of brings it back to why maybe this deal might make sense, because the timelines on some of these initiatives are far longer than, your quarterly earnings cycle on the street. And so, if you're the management team at Walgreens and you're tired of playing the quarterly earnings call game and you've got these long time horizons to create value, maybe being private makes sense.
So just give us a sense of how this business is. You mentioned the competitive landscape. I think, you mentioned Amazon, Costco. You think about these big box retailers getting into the pharmacy business. First of all, I say why, but I can recognize how that would be really a competitive threat to some of the traditional players. Is this a business that's growing at all?
It's still got growth. It's not rapid growth. I mean, 10,000 people a day are going on Medicare and turning 65. So, and that's the people who use the most prescriptions. I think the number is something along the lines of, Medicare recipients, get 30 something prescriptions per year versus the average person gets, 5 or 6 or something like that. So the demographics are shifting. The demographic shift in the U.S. is really, favorable for these companies. It's just, there's a lack of ability to consolidate. CVS and Walgreens aren't combining. Walgreens tried to buy Rite Aid a couple years ago. The government put the kibosh on that. So really, you have to find new areas of growth outside of just that demographic phenomena.
So again, if this deal were to go through, it's a lot of debt is going to need to be raised here. Is this a business that can support a lot of debt?
That's the big question I think a lot of people have been asking about this rumored deal, because you kind of look at the numbers and, roughly $60 billion of new debt would have to be raised to fund this deal. And Walgreens is only generating about, $8 billion in EBITDA. I don't know that investors would be entirely comfortable, putting 8 times leverage on a retail business with the potential for Amazon to come in, the potential disruption from, the government. We haven't talked about opioids, but Walgreens is involved in the settlement there as well. So there's a lot of risks to the business model, both from an operational perspective and then, from a geopolitical and regulatory perspective as well.
Jonathan Palmer, thank you so much. Jonathan Palmer is a senior healthcare analyst for Bloomberg Intelligence, joining us here in the Bloomberg Interactive Broker Studio to talk about this possible LBO of Walgreens, the Boots Alliance. Again, the total enterprise value, just looking at it today, is $70 billion. So this would be a huge deal, require a lot of debt in the marketplace, just as maybe the debt markets might be tightening up a little bit. So we'll see how this plays out. We'll certainly follow up on this story with Jonathan and with others. Looking right now, the futures quiet out there. S&P up 3, the Dow up 33, NASDAQ up 6, and about almost 7 points on the NASDAQ. 10-year Treasury up 8/30 seconds, pushing that yield down to about 1.82%. The 2-year yield 1.6%. So we have a little bit of steepening on the yield curve. This is Bloomberg. Let's get national headlines right now with Michael Barr. Michael.
Thank you very much, Paul. The State Department's number 3 official is preparing to weigh in on the controversy over relations between the U.S. and Ukraine. People familiar with the matter say David Hale is expected to testify during a House impeachment deposition today. Hale is said to testify that political considerations were behind the department's refusal to actively defend the U.S. ambassador to Ukraine when she was recalled early at President Trump's demand. An arrest has been made after the brutal massacre of 9 Americans who lived in a northern Mexican Mormon community. The arrest comes just a day after women and children were brutally attacked by criminal groups while driving near the U.S.-Mexico border. Global news 24 hours a day, on air and at TikTok or on Twitter. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr. This is Bloomberg, Paul.
Michael Barr, thank you so much. We have a quiet morning here in terms of futures as we wind up third quarter earnings. We'll bring it all back to you.
business is constantly evolving. Is your financial printer evolving to keep ahead of the curve? At Command Financial, we are redefining financial printing by providing industry-leading expertise, leveraging technology, and honing processes and best practices. Every day, Command helps SEC registrants, as well as members of their working groups, including securities attorneys and investment bankers, prepare, file, and disseminate regulatory and disclosure documents, such as registration statements, M&A documents, and mutual fund prospectuses and reports. Command provides a full range of services to help you effectively complete your deal, meet your disclosure requirements, and achieve your shareholder communications objectives. Visit our website at commandfinancial.com and learn how we're evolving, not only with the times, but also with your business requirements. Command Financial, redefining financial printing.
Imagine being denied an apartment because of your religion, or your race, or because you have children, or a disability.
It's so wrong.
Yes, but who has the power to stop this?
You do. Each of us has the power. The law is on your side. It's illegal for landlords to discriminate because of race, color, religion, sex, national origin, disability, or familial status. If you suspect that you have experienced housing discrimination, file a complaint with HUD immediately so we can investigate it. Fair housing is your right.
Use it.
To learn more, visit HUD.gov/fairhousing. That's HUD.gov/fairhousing. Or call 1-800-669-9777. 1-800-669-9777. A public service message from HUD in partnership with the National Fair Housing Alliance.
It's another Wednesday afternoon, yet another cold day. So ditch the British winter and chase the sun across the globe with British Airways from London Gatwick and witness luscious scenery and calming waves. Fly from London Gatwick to St Lucia with British Airways, with flights and 7 nights hotel from just £739 per person. Don't miss out. Book by November the 12th at ba.com/wintersun. With British Airways, incredible is within reach. Booking fees and conditions may apply. Limited availability. Selected flights in March.
They don't chant your name when you give blood, or sing songs about you. But patients and their families will remember you forever. Because your blood can change their lives. We need more blood donors in Tooting, the West End, and Edgware. Bleed for London. Join us today at blood.co.uk.
In cinemas November 15.
So you're going to build a car to beat Ferrari?
With a Ford. Correct. Get ready for Le Mans 66.
I hate guys like us because we're different.
Starring Matt Damon and Christian Bale.
What are they doing? Making your car go faster. That's more like it!
Based on the incredible true story.
You got a plan? It's high risk.
Of Ford versus Ferrari.
No, I thought the whole point was to win the damned race.
Le Mans 66.
Hit it.
In cinemas and IMAX November 15.
London, switch to Vodafone, the UK's best mobile network, and Be Unlimited, because the best phones deserve the best network and our new unlimited data plans. The future is exciting. Ready? Vodafone.
Max download speeds apply to unlimited data. Best network as voted by readers of trusted reviews. Terms at vodafone.co.uk/unlimited.
Influential conversations from Bloomberg Television. Here's Sherry Ann.
Good news is bad news for the bond market. Trade deal optimism and solid U.S. factory data, deepening U.S. services data, deepening a global bond sell-off. For advice on where to find value, let's turn to Tony Cousin, CEO and CIO of Perform International, the global equities division of BMO Global Asset Management. Global stocks, as well as Asian stocks, seem to be right now in overbought territory. Maybe the S&P 500 still not quite there on the 14-day RSI. Perhaps it could still have some room. So where are you seeing the opportunities?
I think the opportunities are very much in Asia. In Europe, they have huge macroeconomic problems, but you can still find some good quality companies in global niches which are not exposed to those problems. And in terms of economic health, Asia, excluding Japan, really stands out.
Why are you excluding Japan? Because the TOPIX is now at the highest level in 13 months, so investors do seem to be liking those stocks.
Yeah, I think the game in Japan is just printing more money, isn't it? You've seen the BOJ now own almost 60% of the JGB market, 25% of the equity market, but the long-term economic fundamentals of Japan still look pretty dire.
Hear more interviews like this one on Bloomberg Television, streaming live on Bloomberg.com and on the Bloomberg mobile app, or check your local cable listings. Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and TikTok on Twitter. This is a Bloomberg Business Flash.
And I'm Karen Moscow. The Bloomberg Futures Report brought to you by IBKR and CME Group. The new Micro E-mini futures contracts are available at IBKR at the lowest commissions. Learn more at IBKR.com/CME Mini. U.S. stock index futures are eking out modest gains along with stocks in Europe as a raft of mixed corporate earnings and economic data muddies the outlook for global growth. We check the markets every 15 minutes throughout the trading day. On Bloomberg, S&P futures are down about 3 points, about 3 points. Dow futures up 24, NASDAQ futures up 6. The DAX in Germany is up 0.2%. 10-year Treasury up 7/32, yield 1.83%. Yield on the 2-year 1.60%. NYMEX crude oil is up 0.2% or 12 cents at $57.35 a barrel. COMEX gold up 0.33% or $5 to $14.8880 an ounce. The euro 1.1086 against the dollar. The yen 109.01. And again, S&P futures up 2.5 points. I was watching shares of Uber Technologies. They are lower, down 6.6% right now. Sources tell Bloomberg a large stake in Uber Technologies changed hands before the market opened today as post-IPO selling restrictions lift for early investors and insiders. And that's a Bloomberg Business Flash. Paul.
Karen Moscow, thank you so much. Well, we certainly know that big technology companies such as Alphabet's Google and Facebook are undergoing a whole host of probes and regulatory reviews by federal regulators, but it's also happening at the state level. And it turns out that, probing and looking at and regulating these big tech companies is not cheap. So a lot of these states are really straining their purse strings here as they pursue some of these wide-ranging probes. To get the latest, we welcome Victoria Graham. Victoria is a Bloomberg Law antitrust reporter. She joins us from Washington, D.C. So, Victoria, give us a sense of kind of how the states are coping with all these investigations going on around big tech, not to mention the opioid crisis and everything else they're working on.
Sure. There's more than 50 attorney generals who are looking at Google. There's 47 attorney generals looking at Facebook, and this even includes Guam and Puerto Rico. And what's interesting, there's some dynamics to it that, the average person might not see at the surface, which is while there's, handfuls, dozens of states looking at this, there's only a core group of states actually a part of the executive committee for each probe. And those are the states that are devoting the most resources, the most time, the most attorneys to investigating these two companies and really putting a lot of money forward and a lot of time and effort to bring a case potentially.
So, Victoria, why are the states looking at this at all? Why isn't this not just a federal level where maybe they certainly have more resources and could maybe pursue this a little bit more aggressively?
Definitely. Well, of course, the Department of Justice and the Federal Trade Commission are investigating tech companies across the board. But states, definitely in the most recent months, have really amped up their scrutiny of tech companies. We saw even Sprint T-Mobile, which is a deal that was cleared by the DOJ. Several state attorney generals sued to block that deal. It's going into trial in December. So states are, really putting their power to federalism, showing that, while we can have the federal enforcers okay a deal or not scrutinize the company, the states have every right to enforce antitrust laws, which mirror the federal level laws as well.
So, Victoria, what do the states really want here? Have they said kind of what they're looking for in terms of remediation or just any kind of changes in behavior?
That has yet to come. These probes are in their very preliminary stages. I mean, the Google one was announced in September. The Facebook one mushroomed to 47 attorney generals in October. And from my conversations with the attorney generals who are part of these investigations, and also for what we see Google and Facebook talk about, these are wide-ranging probes. I mean, company documents spanning from acquisitions to internal executive emails have been asked by the companies. So it's really anything's fair game. I think one of the top acquisitions that's gained a lot of scrutiny is Facebook's past acquisition of Instagram. And states and also the federal enforcers are seeing if deals like that were done just to squash potential threats of new competitors.
Are the states cooperating at all to maybe share resources and ease the burden?
Oh, of course. When states enter into a multi-state investigation, there is a cost share plan. So all the states, before they sign on and publicly announce that they are spearheading this together, they say, X so-and-so state's going to front this many resources. So typically you see California, New York, and Texas are the three states that really spearhead multi-states because they have the largest populations, the most resources. But what's interesting about both the Google and Facebook probe is that California is missing from both of them. That's not to say that California isn't doing an investigation on their own, but they are. It's clear that they are not a part of these multi-states into either tech company.
Yeah, that's very interesting with Silicon Valley, of course. It's interesting. What a lot of the tech investors, I think, are concerned about is that there's really been a change in tone as it relates to federal and state regulatory views of big tech. Historically, the U.S. has taken a very light touch. But now, over the last couple of years, it seems that we're seeing more and more regulatory oversight, more and more technology executives being hauled in front of Congress. Is there a sense that at the state level, they're saying, gee, if the feds are going to start looking at these guys, that gives us a green light to do so as well?
I definitely think that's the case. What's even possible is the states could be more aggressive enforcers, be more aggressive investigators than the Department of Justice. For example, in Ohio last month, their state legislature held hearings about how they could revamp their antitrust laws to go after Facebook and Google in particular. So the states are really thinking outside the box, whereas the federal enforcers, particularly the DOJ, they've been kind of slammed in the past for, not thinking outside the box, being very stringent in how they view the antitrust laws, whereas European enforcers, especially in the EU, are, fining Google, fining tech companies multi-billions of dollars. You hear about these fines almost every other month, it seems like.
But there's no sense of these companies being broken up? Is that your belief?
There has been talk. We saw Making Delrahim, the head of the DOJ, talk about it could go as far as a breakup if that is warranted. But a breakup, you have to go to court for that. And we saw with the Microsoft case back in 1998 when it was first brought, a breakup order was initially ruled, but then it was actually dialed back in an appeals court. So it's very tough. The last breakup we saw, you think back to Standard Oil. It's a very high burden to bring. And even if the states and the federal enforcers have a great case, it all matters to one judge in the very end.
Very good. Victoria Graham, thank you so much for joining us. Victoria Graham, Bloomberg Law antitrust reporter, giving us an interesting story here as the states pursue some of these big tech companies. It really stretches their financial resources because we certainly know that the tech companies have very deep pockets and can litigate every and all of these regulatory issues going forward. So we'll have to see how this plays out. But both the federal level and at the state level, we'll keep up. This is Bloomberg.
This is a Bloomberg Market Minute. It looks like Wall Street will notch more record highs, at least at the open today. The stock futures are rising. Dow futures up 35 points. Walgreens is reviewing a potential deal to take the company private in what would be the largest leveraged buyout in history. The move would give Walgreens time to adapt to the fast-changing retail environment, free from the quarter-by-quarter demands of public shareholders. Walgreens also owns Duane Reade stores. It has a market value of about $55 billion and almost $17 billion of debt. Adidas sales are picking up in the U.S., and that's helping the shoe and sports maker beat earnings estimates in the latest quarter. The U.S. gains were welcome news for Adidas after months of problems from supply chain snags. And Impossible Foods, maker of the Impossible Burger, is working to launch plant-based pork as it looks to enter China, the crown jewel of the $2.7 trillion global meat market. Gina Cervetti, Bloomberg Radio.
Have you wanted to speak a new language, but you thought it'd be too hard or take too much time? Then go to Babbel.com, download the app, and try it for free. In just 15 minutes a day, you'll be on your way to speaking a new language in just a few weeks. And right now, you can try Babbel for free. Babbel starts out teaching you words and phrases by matching them with pictures. You won't believe how easy the interactive program is. Soon the sentences get a little bigger, and before you know it, you're having simulated conversations voiced by native speakers. And because Babbel is crafted by language experts and uses the spaced repetition method, in just 10 to 15 minutes a day, you'll be speaking the language of your choice with real confidence. With Babbel, you can speak a language. Just go to Babbel.com and start your first lesson in the language of your choice for free. Download the Babbel app or go to Babbel.com and try it for free. That's Babbel.com.
It's another Wednesday afternoon, yet another cold day. So ditch the British winter and chase the sun across the globe with British Airways from London Gatwick to enjoy a warm Bayesian welcome.
How are you doing? Enjoying the sunshine?
Fly from London Gatwick to Barbados with British Airways, with flights and 7 nights hotel from just £699 per person. Don't miss out. Book by November the 12th at ba.com/wintersun with British Airways. Incredible is within reach. Booking fees and conditions may apply. Limited availability. Selected flights in March.
Whatever job you're searching for, you can find it on LinkedIn. First jobs, flexible jobs, work from home on a Friday jobs, advertising jobs, accounting jobs, HR, PR, even ER jobs, Soho jobs, Shoreditch jobs. Keep me away from the central line jobs. Banking jobs, building jobs, never ever boring jobs. Small jobs, big jobs, lunch in Borough Market jobs, or even voiceover jobs, which is how I ended up recording this ad. Search millions of jobs on LinkedIn and find one meant for you.
London, switch to Vodafone, the UK's best mobile network, and Be Unlimited, because the best phones deserve the best network and our new unlimited data plans. The future is exciting. Ready? Vodafone.
Max download speeds apply to unlimited data. Best network as voted by readers of trusted reviews. Terms at vodafone.co.uk/unlimited.
Ladies and gents, may I introduce a magical number? 25! Oh yes, 25 UK millionaires guaranteed in this Friday's Euro Millions.
Euro Millions, celebrating 25 years of the National Lottery. Your numbers make amazing happen. Rules and procedures apply. Players must be 16 or over.
Whether you're waiting for a train or a takeaway, with Tesco Mobile you don't have to wait for a brilliant deal. Our best ever Black Friday event is on. This week you can get a Samsung Galaxy A50 for just $17.49 a month. That's our lowest ever price. Get yours by the 10th of November. Tesco Mobile. Every little helps.
Best ever Black Friday based on range of products in promotion was £18.99, now £17.49. 36-month credit agreement, rolling monthly usage agreement, subject to status, phase policy applies. See tescomobile.com/terms.
Gosh, can we put the heating on?
Sorry, it's broken.
Can I play some tunes on my phone then?
Yeah, afraid not. Play CDs though.
This car belongs in a scrapyard.
I know, but I get nothing if I scrapped it.
Actually, you can get at least £2,000 off a new Ford for it.
Really?
With Ford's new for old scrappage scheme, you can get between £2,000 and £4,250 off a new Ford car if you scrap an eligible vehicle with us responsibly. Also, there's 0% APR representative on Ford options. Ford. Together, we go further. Search Ford Scrappage. Exclusions apply. Contracted and registered by 31st of December 2019 at participating dealers. Age and ownership criteria apply to scrappage vehicle. Subject to status. Free post Ford credit.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119 and around the globe. The Bloomberg Business app and BloombergRadio.com. This is Bloomberg Surveillance.
Good morning, I'm Karen Moscow, along with Lisa Abramowitz and Paul Sweeney, and the opening bell brought to you by SEI. With a 50-year history of innovation, SEI's outsourced solutions help achieve lasting success for investment managers, asset owners, private banks, and independent advisors. Learn more at SEIC.com. The S&P 500, little changed at the open at 3074. The Dow Jones Industrial Average, also little changed, up 3 points at 27,495. And the NASDAQ is down 0.1% on 11 points to 84.22. 10-year Treasury up 9/32, yield 1.82%. The yield on the 2-year 1.60%. NYMEX crude oil up 0.1% or 5 cents at 57.28 a barrel. COMEX gold up 0.33% or $4.60 at 14.8860 an ounce. The euro 1.1083 against the dollar. The yen at 109. Paul and Lisa.
Karen Moscow, thank you so much. Well, the on-again, off-again momentum behind the trade deal between the U.S. and China seems to be on again. The momentum, again, seems to be building a little bit, maybe even get a phase one type of deal signed next month. That would be good for financial markets, including emerging markets. To get the latest, we welcome Esther Law. Esther is an emerging markets fixed income portfolio manager for Amundi Asset Management, located in London. Esther, thanks so much for joining us. So give us your sense of kind of how you think this trade negotiation is going and what might be in a trade one, a phase one type of deal, and kind of what you think that would mean for emerging markets.
Yeah, good morning. I think the deal, like the mini deal, is somehow already priced in, but nonetheless, when we have a confirmed mini deal or phase one deal comes through, there should be some relief in emerging market assets, especially on EMFX, which has been lagging the move in the hard currency bonds in particular.
You know, I got to say, we get these headlines every day. President Trump coming out and either indicating it's a go or it's not. Today, it's a go. On the Chinese side, we have gotten a little bit of conflicting messages. Overnight, there was a report saying that they were worried that they were giving in too much to Washington and not getting enough in return. How concerned are you about that type of line out of the PBOC and out of Xi Jinping?
I think having seen so many back and forth, like you said, the market is much more massaged and used to this uncertainty. I am a bit worried more because of the price actions getting ahead of itself, thinking that there will be more than just, like, let's say, a pause in the tariffs. But I really don't expect a very smooth and straight road on this trade war. I do think that there will be constant back and forth, and volatility will just become part of our lives.
So, Esther, as it relates to emerging markets, I mean, maybe I'm just too risk adverse, but it's awful difficult for me to envision investors taking any type of bullish stance on emerging markets generally, given this trade uncertainty, which may or may not be resolved in the next couple of months.
I think, yes, the trade uncertainty will not be a positive sign, and it will continue to weigh on more growth forecasts going forward. However, I think we are in a world that is offset by the very loose monetary policy globally, and that has really made EM fixed income in particular looking very attractive. Ultimately, I think the EM debt returns have a lot to do with the inflows, and should we have the negative yield persistence in the coming months, that will still be relatively supportive for EM fixed income, whereas for EM FX and EM equities, that will be a bit more unclear uncertainty.
Esther, what's your highest conviction bet right now?
I think we have to go through our usual list to select a good fundamentals, and ideally with as less noise as possible. I quite like Russia because I believe the fundamentals are very strong, and they've gone through a lot of adjustments in terms of adjusting to sanctions. So in a way, they are already quite closed in many manners, and the execution of the fiscal rule has been very resilient, and that's helping the fiscal matrix becoming very sound.
So in terms of Latin America, I know there's so much political uncertainty down there. It makes it very difficult for investors to look at that area with conviction. How are you approaching kind of Latin America broadly defined? Are there any areas that you find of interest?
I think at the moment, with the recent news flows, Brazil is coming out as a more positive on the margin. The FX is still going to be a bit volatile, but I think the passing of the pension reforms has removed a big uncertainty out of the way, and that should start to see external investors going back more into the fixed income market.
So you said the central banks are sort of giving a bit of a tailwind to emerging markets, although today it does seem like the mood is that central banks are moving toward a holding pattern rather than an easing pattern. Is that enough, just a holding pattern here across the board, to continue to support emerging markets?
I think the holding patterns, in a way, are actually positive for the currency to stop the yield spread being narrower. we only need a hold plus a relatively positive backdrop externally. I think that is still a case for EM debt.
Esther Law, thank you so much for joining us. Esther is Emerging Markets Fixed Income Portfolio Manager for Amundi Asset Management, joining us from London. It's a really interesting time, Lisa, for emerging markets, because on the one hand, as you mentioned, interest rates are so low worldwide, and there seems to be a easing on, across many of the major markets. Yet, on the other hand, you have that uncertainty about trade, and that affects so much of how emerging market investors view the markets.
Let's give some statistics. So year to date, if you take a look at local currency emerging markets debt, it's gained 7.8%. Pretty good, right?
Yep.
But compared to U.S. high yield bonds, they are up 12%. So lagging behind. However, if you take a look since the end of September, this is something that's interesting to note, because my bigger idea here is emerging market debt has been lagging behind developed market debt all year. That has started to change. Since the end of September, local currency emerging market debt has gained 3.3%. That's more than triple what the U.S. high-yield bond complex has gained, which is up a mere 0.6 of a percentage point. So just giving you a sense of this divergence, it does seem to be gaining steam, and there's money moving back into EM. My question is, how much is this becoming consensus? How much is this playing catch-up? And how much more room does this have to run, given the fact that even any deal between the U.S. and China is going to be pretty slim? Pretty narrow.
Yeah, it's exactly right. A light trade deal. But that might just be what the EM is just kind of looking for. But as Esther suggested, she's concerned, put words on her, paraphrase kind of the emerging market investors kind of getting over their skis a little bit. Maybe it's a little bit ahead of itself.
Yeah, although I will say this, the other thing that's interesting to me is back in 2013, a lot of money went into the emerging markets complex through ETFs, through index funds, and it was pretty indiscriminate. What do you get now when you have these sort of potholes of Argentina and Ecuador and Lebanon, which was just downgraded, by the credit rating agencies? Michael Barr walking in here looking really excited. Michael, do you have a view on emerging markets?
Oh, they're emerging. Yes.
They're emerging. That you just heard it from the voice of God himself. They are emerging.
Yep, they are emerging, and it takes a hardy soul to invest in emerging markets. We've seen that they have been lagging, as Lisa mentioned, but a little bit of a outperformance just in the last several months, and it's interesting time for emerging markets. Clearly focusing on the global trade deal is perhaps a green light to maybe dial up the risk a little bit. Look at the markets here, just very, very quiet here. S&P down 3.5 points. This is Bloomberg Surveillance.
Sitting here developing all of the world's national headlines is our own Michael Barr. Michael.
Thank you very much, Lisa. Thank you, Paul. In a race deemed too close to call late last night, Democratic candidate Andy Beshear declared victory in Kentucky's governor race over current Republican Governor Matt Bevins. Beshear leads by about 4,000 votes. In Virginia, Democrats are celebrating their dominance of both houses of the state legislature for the first time in more than 20 years. Publicly released transcripts show U.S. Ambassador to the EU, Gordon Sondland, returned to give lawmakers new details that's in line with other witnesses who say President Trump tried to pressure Ukraine into launching investigations into Joe Biden. Democratic Congressman Eric Swalwell sits on the House Intelligence Committee.
Even when someone's not completely forthcoming and then they come and revise and they give new information, there's still information that they may hold and they may not just want to say it yet. We want Ambassador Sondland, if he does come in under oath, to give us the complete, unvarnished truth. We have this evidence, though, from other witnesses who have said that Sondland has put himself out there as an agent of the president. The president said, "You're my guy on Ukraine."
We've learned New York City Police Commissioner James O'Neill will be going to work for Visa next month as a senior vice president and global head of physical security. O'Neill announced Monday that he will be retiring from the NYPD. Global news 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Michael Barr. This is Bloomberg, Lisa.
Michael, thank you so much. We're looking at the broad U.S. equity indices. They have found a direction. That direction is down, led by the NASDAQ, down 0.3%. Give whatever narrative you want to this one. You have our permission because everybody else is doing it. This is Bloomberg.
Rich is just a really good guy. The term good egg isn't enough to describe him. He's also certified organic and free range. Rich puts the cap back on everything. The toothpaste, the olive olive oil, the shampoo, everything. He lets his 10-year-old nephew beat him at virtual tennis, even though he can straight up slay his 10-year-old nephew in virtual tennis. When the toilet paper is running low, Rich replaces the roll on the actual holder, not just on the back of the toilet. Rich is texting and driving. Rich? No. What are you doing, Rich? I was just telling everyone how great you are. Texting and driving makes good people look bad. Visit StopTextStopWrecks.org. A public service announcement brought to you by the National Highway Traffic Safety Administration and the Ad Council.
Asset managers who seize change to launch new strategies, add distribution channels, or exploit new technology to re-engineer the investor experience are often rewarded. However, in an industry paralyzed with complexity, few act with agility or decisively. Few run their business strategically. Yet, the most competitive managers in the market know, with the right partner and a flexible operating platform, you can. Go boldly toward change with SEI Investment Manager Services.
Determination and operational strength are both essential factors for growth in asset management. I'm Steve Meyer, President and Head of SEI's Investment Manager Services Division. We know that disruptive forces create opportunities around the world. If you see potential in change, our industry specialists will maximize SEI's integrated platform of data and risk management, global investment operations, compliance support, and investor services to position your asset management business for success. Come grow with us.
With SEI Investment Manager Services, you lead the charge in a competitive marketplace. Learn more at SEIC.com/seizechange.
This is a...
It's another Wednesday afternoon, yet another cold day. So ditch the British winter and chase the sun across the globe with British Airways from London Gatwick. Experience Mexican culture and relax by the Caribbean Sea. Fly from London Gatwick to Cancun with British Airways from £275 each way based on a return fare. Don't miss out. Book by November the 12th at ba.com/wintersun with British Airways. Incredible is within reach. Booking fees and conditions may apply. Limited availability. Selected flights in March.
Ladies and gents, may I introduce a magical number? 25! Oh yes, 25 UK millionaires guaranteed in this Friday's Euro Millions.
Euro Millions, celebrating 25 years of the National Lottery. Your numbers make amazing happen. Rules and procedures apply. Players must be 16 or over.
Whether you're waiting for a train or a takeaway, with Tesco Mobile you don't have to wait for a brilliant deal. Our best ever Black Friday event is on. This week you can get a Samsung Galaxy A50 for just $17.49 a month. That's our lowest ever price. Get yours by the 10th of November. Tesco Mobile. Every little helps.
Best ever Black Friday based on range of products in promotion was £18.99, now £17.49. 36-month credit agreement, rolling monthly usage agreement, subject to status, phase policy applies. See tescomobile.com/terms.
Can I have chemo at home?
It's only suitable for a couple of times.
When you search one question about cancer, you end up with millions of results which contradict each other. For clear and uncomplicated information, come to Cancer Research UK. Visit us online or give us a call on 0808 800 40 40. Cancer Research UK. Together, we will beat cancer.
Global news 24 hours a day, on air and at TikTok on Twitter. Powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg Radio. Now, a global news update.
Police in Mexico have arrested a suspect in the massacre of 9 members of a Mormon family in Mexico on Monday. Correspondent Matt Rivers in Mexico City.
This is a country that has seen, on average, every single day so far in 2019, nearly 100 people murdered. And yet this massacre of 9 people in northwest Mexico has really shocked this country.
Voters yesterday gave control of the Virginia legislature to Democrats for the first time in a generation. Ralph Northam is the state's governor.
This is an exciting day for the Commonwealth of Virginia. After 26 years, we are officially blue.
David Hale, the third highest ranking official in the State Department, is testifying this morning before House committees investigating President Trump. This late word, a shooting this morning at the Cape Fear Valley Medical Center in Fayetteville, North Carolina. A patient struggled with a sheriff's deputy and tried to take the deputy's gun in the struggle. The deputy may have been shot, but it's not clear. Police say the situation is now under control. I'm Christopher Cruz.
They like new developments.
This is an industry that is in demand.
They love telling you about all of them.
What will society ultimately decide?
Carol Messer and Jason Kelly. Bloomberg Business Week. Weekday afternoons at 2 Eastern on Bloomberg Radio. Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at TikTok on Twitter. This is a Bloomberg Business Flash.
And I'm Karen Moscow, and this update brought to you by Eisner-Amper. Taxes are one of the certainties of life, but what worked for corporate taxpayers in the past may not work today. Eisner-Amper can help. Visit EisnerAmper.com/tax certainty. And U.S. stocks, little change to lower this morning, while stocks climbed in Europe after a raft of mixed corporate earnings and economic data muddied the outlook for global growth. Treasuries rebounded after dropping for 3 days, and we check the markets every 15 minutes throughout the trading day on Bloomberg. The S&P 500 is little change, down almost 2 points at 3072. The Dow Jones Industrial Average is down 19 points now, almost 0.1% at 27,473. And the Nasdaq's down 0.3% or 23 points at 8411. The 10-year Treasury up 10/30 seconds, yield 1.82%. Yield on the 2-year 1.60%. NYMEX crude oil is up 0.2% or 10 cents at 57.33 a barrel. COMEX gold up 0.4% or $6.10 at 14.89.90 an ounce. The euro 1.1082 against the dollar. The yen is at 108.98. Watching shares of HP up more than 11.5% after the Wall Street Journal reported Xerox is considering a cash stock offer for the PC maker. Sources tell Bloomberg a large stake in Uber Technologies changed hands before the market opened today as post-IPO selling restrictions lift for early investors and insiders. And Uber shares, they're down 5.8% right now. And sources also tell Bloomberg that Chinese state-owned entities are in talks about investing a combined $5 to $10 billion in Aramco's initial public offering as Saudi Arabia seeks commitments from friendly governments to shore up the record share sale. And that's a Bloomberg Business Flash. Paul and Lisa.
Thank you so much, Karen. Bloomberg Surveillance brought to you by Interactive Brokers, rated #1 best online broker in 2019 and low-cost online broker for the 18th consecutive year by Barron's. Learn why at ibkr.com/YIB. SoftBank really in the front and center today, and I have to wonder, Paul, and I know I tend to be catastrophic in my thinking, but how big of an issue is SoftBank's Vision Fund and some of the losses that it's been taking, given the fact that they have really bid up the valuations of some of these tech companies, and that bleeds into all the venture capital and private equity firms that have invested right alongside them.
You're exactly right. It really questions, have we seen a top or a bubble bursting here in terms of private market valuations? And just crossing the Bloomberg terminal, Uber, another one of their investments at SoftBank, sinks 6%. It's the most active traded stock today as the lockup expires. So that stock is down 5.5% today. Over 50 million shares of Uber have traded today. So let's get a sense of what this means for global Wall Street, global finance. We do that with Shonali Bosick. She is the person who covers all that great stuff for Bloomberg News and Bloomberg Television. She joins us here in our Bloomberg Interactive Broker studio. So, Shonali, as we think about just, over the last couple of months, what's happened, the Uber IPO, kind of underperforming significantly, Lyft, Smile Direct, with the pulling the deal for WeWork. What is your sense of what are some of the repercussions for global Wall Street?
For global Wall Street, will there be IPOs to lean on?
Yeah.
A number that I've been showing people this morning is not even just capital raising on the equity side, but if you look at SoftBank's cash burn, it's quite significant. So I'm going to get really wonky for Lisa here. We have SoftBank here, highly levered on so many levels. Their portfolio companies, highly levered on many levels. You have Walgreens Boots thinking of doing the largest ever buyout that would require significant debt. Investors are getting nervous everywhere, but it's a low interest rate environment. So what kind of risks are they going to take on?
Well, you have seen pushback, though. I mean, when you talk about the Walgreens and deal that they were talking about, the taking private deal that could be the largest leverage buyout in history, and we're going to be talking more about that coming up in detail. You are getting pushback prematurely from debt investors saying, hey, we don't want this. And banks, if you underwrite this, watch out. You might get those loans stuck on your balance sheet.
I think what surprised me, though, and I'm not by any means, I think there's a lot of doubt about Walgreens in the market now, but, there's a lot of doubt about SoftBank, too. And people are still pouring in.
Well, are they, though? And I think that this is sort of the question, right? And I think I keep repeating this, but I just find it stunning, to use Tom Keene's word, that nearly 2/3 of the money in the Vision Fund, the $100 billion Vision Fund, is borrowed money.
Yes.
And it's borrowed at a 7% interest rate. So it's not as if the initial investors, were necessarily just piling in a whole hog without having any skepticism whatsoever.
It's not cheap to pile in.
Well, it's not cheap for SoftBank to attract them. So my question is, are they going to be able to raise more money?
I think that is the question. The second Vision Fund here, it's not clear whether the initial investors are going to get back in. Are we going to really see a halt in this strategy, or are we going to see people pour back in? I don't know. I think if they don't go to the Vision Fund, I think we'll find money flow in from somewhere else, because the world is still awash with capital.
So it's, we talk about that Walgreens deal, that potential deal. It's still being just discussed. What's been the M&A market so far this year? Is 2019 going to go down as a decent year for M&A?
It started off looking not that great, and it's still not that great, but it's not as bad as we initially thought.
Okay.
I think that leaves us in a place where all the bankers can walk away okay. I mean, all the banks took pretty significant nosedives in all of their investment banking activities this year. Right? You've seen it in the numbers play out. But with that said, again, the ones that are pivoting to different strategies, the ones that are focusing on private deals, middle market, private capital raising, they're just kind of fine.
Well, one thing that I was struck by were the productivity numbers that came out this morning. Third quarter productivity year over year unexpectedly posted the first decline in almost 4 years. This stems from the fact that companies are paying employees more to hire people, and they're not necessarily seeing their output increase with commensurate increases in labor costs. And I'm trying to figure out what this means for M&A, because that's been the one source of growth or any kind of hope for acceleration is let's just join forces, make some cuts, and try to move forward.
You know what I love about bankers is how optimistic they are. Look at the productivity numbers and say, Lisa, that's a reason that you need to look to technology to change your business. So you should go buy a tech firm.
Okay, so that if that's the story, then please explain what's the rationale between Xerox potentially taking over HP?
Carl Icahn.
Yeah.
That's
you think
what
about
I'm saying.
Yeah.
These deals are not always driven by markets, right? A lot of these times, these things are driven by personalities. You're bringing up the productivity numbers. I'm looking here at what Paul Tudor Jones was saying yesterday about how this is the most conducive global growth environment. Is he looking at the numbers? Right. Clearly, you have one of the world's greatest minds or whatever in investing, and he's looking at a different set of data than we are today. So I think that there's going to be haves and the have-nots, if that makes sense.
Right. So we started talking about some of the weak and disappointing IPOs for 2019. Again, 2019, we kind of came into the year thinking this is going to be the great year for all the unicorns to come public, and so much wealth is going to be created for everyone, including the bankers. So we have had some very, very notable disappointments. Again, Uber, WeWork, Lyft, Smile Direct, you take your pick. Overall, how has the IPO market been in 2019?
It's funny. Again, the optimistic bankers, we do read about the big headlines, the Smile Directs, the Pelotons, the tough times, the Lyfts, the Ubers. But, the biotech market has been pretty good. People are still going out there and raising money in capital markets. You had the spaceship IPO, you had the Virgin Galactic SPAC, right? I mean, people are still raising money in public markets, but it's not the heyday by any means.
Well, what's interesting to me is that you can say, all right, well, the bankers are optimistic, but in some ways, they're more realistic than the private markets have been.
That's Barry Ritholtz's argument.
Yeah, and you've actually had more rationalization. You've had more discipline in the IPO market than you've had in the pre-IPO market that sunk WeWork and that sunk that put too high of a valuation on Uber and Peloton, et cetera.
What's funny about that, Lisa, is that I've been thinking about the next couple years, because if interest rates are low, and if we have to face this reckoning of this bull market, do all the tides rise, or do you just see some laggards? Do the good stocks start starting to rise, and then do the bad ones start to fall behind? That's a hedge fund manager's dream, because guess what? That's dispersion in the market,
and that's what we're seeing, and we're certainly seeing that in bonds. I mean, what you're seeing with respect to the energy companies, they're getting penalized and they're falling out of bed and filing for bankruptcy, and then you have on the flip side higher rated junk bonds doing really well. I mean, you are seeing that discretion increasingly.
Stock pickers market, right? I mean,
let's see if they can pick the right ones.
Exactly.
All right, I did this real quick. It's November, and after spending 20 years on Wall Street, I'm conditioned to start thinking about bonuses. How are Wall Street bonuses going to be this year?
They ain't good, Paul.
Okay.
So, I mean, we are definitely waiting for all the recruitment numbers to start coming in. Even in private equity, where they've raised record funds, have been trying to put more money to work, the numbers are bigger, but they're not crazy big. Investment banking will be lower, trading will be lower, wealth managers might make some money, but generally, I think in the next week or so, we'll see some significant projections coming out about what this will look like.
Sonali Basak, thank you so much for joining us. It's been an interesting week, and certainly the news about Walgreens Boots Alliance possibly going private, very interesting to me. Not just from the idea of it being potentially the largest LBO ever in history, but also the desire to go private right now. Why, right?
Yeah, it's interesting. We had Jonathan Palmer from Bloomberg Intelligence on earlier, and he says it is a tough business. New competitors coming in. You've got maybe Medicare for all. There's a lot of challenges here, and maybe it's better just to be private. But the capital structure they're talking about, wow, it's a lot of debt that would have to be raised.
Indeed. Right now we're looking at markets lower, led by the NASDAQ, down 0.2%. S&P and Dow, little changed. I'm Lisa Abramowitz, alongside my co-host and colleague Paul Sweeney. We're going to be talking more about that Walgreens Boots Alliance take private deal coming up. This is Bloomberg.
It's another Wednesday afternoon, yet another cold day. So ditch the British winter and chase the sun across the globe with British Airways from London Gatwick, and witness luscious scenery and calming waves. Fly from London Gatwick to St Lucia with British Airways, with flights and 7 nights hotel from just £739 per person. Don't miss out. Book by November the 12th at ba.com/wintersun. With British Airways, incredible is within reach. Booking fees and conditions may apply. Limited availability. Selected flights in March.
London, switch to Vodafone, the UK's best mobile network, and Be Unlimited, because the best phones deserve the best network and our new unlimited data plans. The future is exciting. Ready? Vodafone.
Max download speeds apply to unlimited data. Best network as voted by readers of trusted reviews. Terms at vodafone.co.uk/unlimited.
Ladies and gents, may I introduce a magical number? 25! Oh yes, 25 UK millionaires guaranteed in this Friday's Euro Millions.
Euro Millions, celebrating 25 years of the National Lottery. Your numbers make amazing happen. Rules and procedures apply. Players must be 16 or over.
Whether you're waiting for a train or a takeaway, with Tesco Mobile, you don't have to wait for a brilliant deal. Our best ever Black Friday event is on. This week you can get a Samsung Galaxy A50 for just $17.49 a month. That's our lowest ever price. Get yours by the 10th of November. Tesco Mobile. Every little helps.
Best ever Black Friday based on range of products in promotion was £18.99, now £17.49. 36-month credit agreement, rolling monthly usage agreement, subject to status, phase policy applies. See tescomobile.com/terms.
Of the world, 24 hours a day at Bloomberg.com, on the Bloomberg Business app, and at TikTok on Twitter. This is Bloomberg Radio. This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney.
Is there any bank right now in the U.S. that you think is a buy?
Do you think Chairman Powell has lost the market?
Jeff Bezos is no dope. What's the big ka-ching?
The big question, I think, for investors is free cash flow.
Breaking market news and insight from Bloomberg experts.
The U.S. tariffs actually hurt both China and the U.S.
Large strategics are looking to either buy or invest in innovation.
Soybeans and corn have been basically at or below the cost of production for about 4 or 5 years.
So what we see more bonds, more yield.
This is Bloomberg Markets with Lisa Abramowitz and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from New York City to our worldwide audience. We have a mixed market here opening here for Wednesday morning. Coming up, we're going to take a look at some of those off-year elections that were held yesterday across the U.S. and what it might mean for President Trump and the administration. Plus, we're also just going to get a look on how to get positioned in this market where we have lower rates for longer. But first, let's go to John Tucker of Bloomberg News for a Bloomberg Business Flash. John.
And looking at the S&P 500 right now, Paul, it's we can say it's unchanged. Some of the individual stocks on the move today. HP, that's rising after a report that Xerox is going to consider a cash stock offer for the PC maker. And Uber, it is sinking for a fifth straight day. The share lockup for Uber, that expired today. Well, it's still hard to make a bear case for the U.S. economy, according to Tom Porcelli. He's at RBC Capital Markets.
I would say that it's really difficult to make the case that the consumer's about to roll over when all evidence to the contrary, right? The consumer's in phenomenal shape.
And we do have some raft of economic data today, including worker productivity, a measure of business efficiency, then dropping for the first time in almost 4 years. Now, the third quarter's decline of 0.3% reflects moderating economic growth and rising labor costs. The productivity gains have been generally weak since the last recession. And as we look at stocks right now, S&P 500 up a point. 3,075 right now. The Dow is 8 points higher. We're at 27,501. And the Nasdaq Composite Index 19 points lower. That's down about 0.2% at 84.15. The 10-year yield right now at 1.82% as we're getting a bit of a bid to this Haven asset up 730 seconds in price. NYMEX crude right now 49 cents a barrel, 57.72. And we check the markets every 15 minutes during the trading day right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash.
John Tucker, thank you so much for that. Market Drivers brought to you by New Jersey Institute of Technology, offering hands-on learning in the largest makerspace in New Jersey for those working in manufacturing and mechatronics. More at njit.edu/manufacturing. Talking about manufacturing technology, NASDAQ leading declines down to 0.1%. The S&P and Dow basically unchanged. Dave Wilson, Bloomberg Stocks Editor, joining us here in the Interactive Broker Studios. And we were just talking about how within the NASDAQ, it's Uber, it's Walgreens, Boots Alliance, dragging things down.
Right. I mean, with Uber, you've finally got the insiders able to sell shares. 180 days have passed since the company went public. So the lockup period that's typically imposed after initial share sales is over. And so you're seeing the stock come to market in a big way. 64 million shares of Uber had traded already, and it's just over a half hour into the trading day. So it just goes to show you how anxious some investors were, at least, to get out of Uber. And then, you throw in what's going on with Walgreens and, the optimism yesterday after we reported that they were considering what